Hello everyone, welcome back to our YouTube channel, and today we are going to look at what we call the pet cash book. So we are going to look at the pet cash book. And this is going to be our video number 1 on pet cash book. So we are going to look at the pet cash book and the implicit system. We are going to look at the pet cash book and the implicit system and how it works. You are going to understand how it works, the implicit system and how it works. Now, what I want you to understand right from the beginning is that there is a type of cash book that is called a pet cash book. There is a type of cash book that is called a pet cash book. And as the name suggests, if you look at the word pet from the dictionary, pet means, it actually means small. It means small, and what we are going to learn about is the fact that we are going to learn about a small cash book. That's what we are going to learn about. Whereby when we talk about a small cash book, we try to maintain a separate cash book which is different from the main cash book. So we try to keep a different cash book that is separate from the main cash book. Of course, the main cash book is what we already looked at. We already looked at what we call a single column cash book, a single column cash book. These are the main cash books. We also looked at the two column cash book, We also looked at the three column cash book. So those are the main cash books that we have in the business. The business has those three as the main cash book. So we are going to keep a separate cash book that is called a pet cash book or a small cash book that is going to be separate from the main cash book that we may maintain in a business. Now, the other key thing that you need to understand is that a pet cash book is not found in every organization, because some organizations don't maintain a pet cash book, but others do maintain a pet cash book, and we are going to understand why. Practically, the reason why some companies keep a pet cash book and others don't is because it all depends on the volume. It all depends on the value of the cash flow. The value of the cash flows each organization has. For example, if maybe we look at a particular company, maybe we look at Chuck's Holdings Uganda Limited, Chuck's Holdings Uganda Limited. I told you this is our company. Of course, this is a company that we have just started this year. So we expect, or it is going to be assumed that as the business is just beginning, we expect the value of its cash flows to be a little bit smaller. So once the values of its cash flows, when we talk about cash flows, we are meaning what is coming in and what is going out of the business, either cash inflow or cash outflow, in terms of the value, or it will be the volume. If let's say this company, maybe its cash flows are within millions, or they are just in hundreds or in thousands. Let's say they are just in thousands of whichever amount. So you'll find that a company that is going to be in millions of its cash flows, that every amount that is maybe coming in or moving out is in millions. And maybe another organization is still having maybe 100,000, whichever thousands, maybe that is still in thousand stages. So you'll see that this company that is within millions, it will have higher values in terms of the amount that is moving in or that is coming in. So some organizations, their cash flows are going to be very huge, to the extent that some small, or what you call the pets, or small expenses, we may call them small expenses. And because I've told you that an organization that has huge sums of money in terms of what is coming in and what is going out, maybe the cash flows are within billions of US dollars, you'll find that some small expenses that are being paid within the organization, when they are recorded in the main cash book, then you'll find that those amounts are going to look immaterial. For those who did the auditing, when we talk about immaterial, you know what we are? Immaterial. Immaterial, or what you call insignificance. It's not a significant amount. Insignificant or insignificance. For example, let's maybe try to imagine an organization that is maybe making billions of US dollars. Their transactions are in billions of dollars. They are in billions of dollars, and most of the expenses in its cash book, they are all going to be, maybe these cash flows are going to be in billions, but maybe what is reflecting in the cash books, they are all in millions of US dollars. They are in millions of dollars. Now, let's assume that that same organization wants to buy something small. Maybe they want to buy books. Let's say maybe they want to buy pens. That is part of stationery. So they want to buy pen. So, and let's assume maybe the pen is costing maybe, let's say $5. It is just $5 US. Now, if we want to record this transaction within the main cash book that is already in millions of dollars, you will see that this $5 will look immaterial. Immaterial means that the amount can easily be ignored, that even when it is ignored, there is no big impact. So in auditing, we look at what we call figures being material. A figure that is material, it is that figure that can change either a profit to become a loss. If, let's say, for instance, we have we have maybe the company has made maybe profit of the profit after tax, and maybe the profit after tax is 10 million US dollars. And you find that within the expenses that they deducted to reach at the profit after tax, they excluded a figure that is, let's say, 12 million. This 12 million will be a material figure, because if it is included, it will change this profit of 10 million into a loss of 2 million. Because remember, for us to get the profit after tax, we have to get the profit before tax. It is within that profit before tax where we have less off the expenses. Let's assume that we had skipped an expense of 10 million. So this 12 million, if included, it will change this profit of 10 million to a loss of 2 million. That figure will be material figure. But a figure is going to be immaterial if it doesn't have any impact. It doesn't have a significant impact on changing the profit or the state of the state of the company. Because I'm just looking at the profit. If let's say the figure we had skipped is, let's say, 5,000 US dollars, you'll find that even if we include this 5,000 within the profit that we had skipped, it will not have so much impact on the profitability of the business. So you'll find that this one will not change much. This 5,000 will not change much from the profitability of the business, because if you less on this one, it will be 9 million, which is still has the same positive profitability. So that's how we can know that the figure is going to be immaterial. So it is the same thing. If the missing expense was $5 US, but the profitability is just 10 million, this $5, even if you include it or you exclude it, the impact won't be so much to change maybe the position of the business. So that's what we call the immaterial. So these figures are too small that when they are included in the main cash book, they will look insignificant or immaterial. So these figures are not going to look material. For example, if all the figures were in millions of US dollars, but you have maybe just 50 cents or maybe 50 US dollars that was included, that figure will look immaterial. So what do we do if the company has very huge values of its cash flows? They are in millions or billions of US dollars. What we do, we make sure that we separate these transactions, these small expenses, into what we call a petty cash book. So that's why some of the companies don't keep a petty cash book, because for a company that is too small, it can incorporate, if let's say all the amounts are in thousands, and maybe their small expenses are now, let's say, 5,000 US dollars, you may find that this figure can easily be included in the main cash book, and the figures will all look material. So that's one of the reasons as to why big companies keep these petty cash books, and that's one of the reasons as why some companies don't keep the petty cash book, because if all your transactions can be included within the main cash book without having to see that other figures are going to be too high, then you will not have any reason as why you should keep a petty cash book. Now, having understood that, we want to see when the things happen. So when such scenarios where the company is having its cash flows in billions, but it has some small expenses that it needs to take care of, because these small expenses are going to be there in the organization. So they will be recorded separately from the main cash book, because their figures are too small to be included in the main cash book. So when that happens, you realize that these pet expenses or small expenses, or the expenses that are of low value, when they are added up in the main cash book with huge amounts, they will make the cash book to look in some way or the other. So what you do, you try and separate these expenses so that you don't exclude them, because they are expenses that are incurred in the business and we need to record them, but only that they are too small to be included in the main cash book. So what you do, you put them in a separate, you record them separately. So you try to separate those expenses which are very small from the major expenses that you do as a business. So you are going to make payments and also receive some cash of the major cash book, but at the same time you go on to create a small cash book called the pet cash book, where you are going to record these small transactions or the pet cash expenses and incomes. So, however, what we normally do in the organization that maintains this system, so when you are maintaining that system, we call it the impressed system. Impressed system. So when you maintain that, we say that you are maintaining that impressed system. And what we basically do with that organization that has that system is that they always have what we call a petty cashier. A petty cashier in the business. This is a position someone holds that office, and is the job for that person. It will be that person who is always in charge of those pet cash items. But what we normally do is that the pet cashier will give something that we call an imprest. It will be from the pet cashier who will give something that we call an imprest. But we are going to talk about the impressed system. We are going to talk about this impressed system a little bit later. Impressed system, and we'll try to explain it. The impressed system as well, because this is the system that is used to operate the petty cash book. Now, what the pet system or the impressed system does is that you are going to be given, this pet cashier is going to be given an amount of money. An amount of money. The pet cashier is going to be given an amount of money, and that initial amount of money that you are going to give to be given as the pet cashier is what we call the cash flow, the cash float. You are given, it's more like these guys who are operating the mobile money. They are given float. They always have that float that they keep sending to different people. So that the cash float is the amount that you are going to be given as the initial amount you are going to start with. It can be any amount depending on how these organizations operate, because these small expenses, they are going to be so many that you can't include them. But and that's why you find that they recruit someone who is going to be managing those small expenses, because they are too small in the amount, but they need to be managed, because if you don't manage it, people are going to misuse the money. They are going to eat the funds. So what you do, you appoint someone who's going to be looking after those small expenses. And every period, maybe within a month, someone is going to be given what we call a cash float. And that is going to be the initial amount you are going to start with. So every time you might be given a different amount depending on the balance that you are left with. Because the initial one they give you is a starting amount. But it doesn't necessarily mean that you are going to spend all that amount at once. It can be a significant amount. They can give you, let's say, 10 million. But you might find that this 10 million, you might spend it for maybe 3 months, depending on those small petty expenses that you keep paying within the organization. So you'll find that the whole petty cashier is just managing the 10 million that was allocated to that small expense. So the initial amount of money that you are given is called a cash float. And let's say the cash float, let's just use a small amount. Let's just work in thousands. We say maybe you are going to be given 1,000 US dollars. And the purpose for this 1,000 US dollars is that you are being given that 1,000 US dollars for you to, this amount is going to be given to petty cashier. It is for you to cater for the petty cash expenses. So how do they know how much to give you as a cash float? It is always an estimate, just like the way we said, like, let's assume that our cash float to be 1,000 US dollars. So the management is going to assume, they are going to make an assumption, or they are going to estimate that maybe within a month we are going to buy, let's say we are going to buy pens, we are going to buy maybe stationery, we are going to buy maybe some sugar and other spices. So you find that these expenses are going to be estimated, that maybe within a month they are going to use, maybe they are going to buy some staple wires, they are maybe going to buy water for the office, they are going to buy reams of paper. So those small expenses that are going to be used within the organization. Now, depending on the size of the organization, you'll find yourself, you are going to buy these small things within a given period of time. And all these things, these small expenses that you are going to be incurring, you are going to buy to use to pick money from this small expense of 1,000 US dollars that they gave you. So your job as a petty cashier is to cater for that minimum amount that they have given to you, or that initial cash float, the initial amount that they have given to you to cater for these small expenses. And what you are going to do is that you are going to make an account for this 1,000 US dollars that they have given to you at the end of the period. So they give you that fixed amount, and then it will be you to keep on accounting for what you have, that I've spent such and such amount to buy pens, to buy rims, to buy sugar, to buy whichever amount. So for example, let's say that they have given to you that 1,000 US dollars, and that amount they gave it to you, it's supposed to be maybe for 1 month. And if at the end of the month, this 1,000 US dollars they gave to you. Maybe you had spent 900 US dollars out of the 1,000. So it means that you are still left with 100. So you have spent 900 out of the 1,000 on the pet cash expenses, or on the petty expenses, or on those small expenses. Then it means that you will be left with that 100 in cash, and that would be the cash at hand. And when you are starting a new month, then you are supposed to be reimbursed. The word is reimburse, reimbursement. Reimbursement. Now, what this is going to happen is that for the first month, let's say this was Jan, they gave you 1,000 US dollars. And within that month, you spent 900 US dollars. So it means at the end of January, on 31st Jan, you still have 100 US dollars. Now, what the organization is going to do, they are going to reimburse. They are going to give you back what you have spent. They are not giving you, in the new month, they are not giving you the whole 1,000 US dollars, but they are just reimbursing you the same amount that you have used in that month. So they are going to give you 900 US dollars, such that within, or at the start of the new month, you'll have a total of the same 1,000 US dollars. But this 1,000 is just the balance you left with from the previous month, plus the reimbursement of the amount that you spent. They give you the exact amount that you have spent. So the reimbursement, it means that you are going to be given only that amount that you have spent, and you are not going to be given the entire 1,000 US dollars. And because on the new month, the month for Feb, they will just give you this reimbursement, so that when you add the reimbursement, that is, they are giving you the amount that you have spent in that previous month, to when you add that to the amount, to the balance that is left on the previous month, you come back to the whole amount, which is the cash float, the cash float. They always give you it is always a reimbursement of the amount, exact amount that you have spent in the month, to make sure that you top up to the other. So there is no way you are going to exceed the 1,000, the cash flow that is given to you, because the moment you see you are going to exceed this, then you ask for the another amount. So if this month you have spent all the money and it all disappeared, then the next month they will give you just a reimbursement. It will be a reimbursement of the amount that you have spent. So they will give you back the 1,000 US dollars. So that's the reimbursement that we are talking about. So it is just, they give you a reimbursement just to restore you to that same amount that it was given to you, or you are supposed to be with every month. Meaning that in this case, they will pay you only the 900, so that you add the balance of the previous month, which is 100, to make it the 1,000 that you are supposed to be with every month. So therefore, this 900 will be the reimbursement, and this means that you are going to be given back the amount you spent from your cash float, and you are going to be given it back to just restore you back to the original position of the cash float that you can just be able to begin with in the new period. And the system of going through this cycle where you are given a cash float, or where you are given a float and you spend it, and again they reimburse you back to that cash float value, that process, it keeps on continuing. And that system is what we call the interest system. So the interest system is the process where they keep on reimbursing you the same amount that you've been using for that month. So the interest system is a system that is used to create pet cash book, whereby the pet cashier is given a float and then is going to be reimbursed at the end of the period, depending on the type of the organization and their policies, because at the end of every period, they can define for you and they give you a reimbursement so that you can come back to the value of your original float. And then you start the new period with it. And that's the concept of the interest system. However, one thing that you should also understand is that it should also be possible that if, for example, the defined period is a month, then it is possible that before the month ends, you might exhaust the whole amount. And when that happens, it's also allowed for you to go for the reimbursement within the same month back to the original float, because they may tell you that you are going to spend this 1,000 US dollars, and you find that the whole this 1,000 is finished within the month of January. So it will be the same thing. If it is finished before the month ends, you also go back for a reimbursement of the same 1,000 US dollars within the month to restore you back to the same position of the original cash float. So that's what you should also understand. So that reimbursement for within the same month will take you back to the original cash float. And it is necessary that you have to wait for it to get done. It's always necessary for you to wait for that cash flow to get done, but you may also have to exhaust you have seen maybe that if you had reached 900 and you see maybe the next expense is going to take you back to maybe 100 and 1,000 then and 100, then you can ask for the amount, because you might see maybe by the time you have reached 900, the next expense is, let's say, 200, but you're only left with 100. You also go back for the same reimbursement so that you can be able to cater for the other amount, the other expense. I want to repeat one thing, and I want to say that you need to understand that it is very possible that if, for example, the defined period is, let's say, it's a month, just like the way we said that it's a month of Jan, and it is possible that before this month ends, you may find yourself that you have exhausted the whole amount. If, let's say, as I told you, that they had given us an amount of a cash float of 1,000 US dollars, it may happen that before the end of this month, you have exhausted the entire 1,000 US dollars. And when that happens, then it's allowed for you to go for a reimbursement. It will be allowed for you to go for a reimbursement within that same period. I'm repeating this because I know this is where the question will come from. So you'll be allowed to go for a reimbursement within the same month, so that you can be reimbursed that amount that you have spent to go back to the cash float of 1,000 US dollars. That is the original float. And it's not necessary that you'll have to wait for this month to end, or even this amount to be consumed, all of it, because it is very possible that you may have maybe used, let's say, 900 US dollars, and you find that maybe your next transaction, the next transaction is, let's say, 200 US dollars. You are seeing, if you deduct this is 1,000, that is the initial they gave to you. If you deduct this 900 you have so far spent, you will see that you'll have a balance of 100. That is 100 US dollars. But you will see that your next transaction is up to 200 US dollars, meaning that amount is not there. The extra 100 is not there, because what is left here is only 100. What do you do in that kind of a scenario? So you are seeing that in the next transaction, you are supposed to income more than what? More than the remaining amount that you have in that same amount, or in that same period of January. So what you do, of course, this petty cashier has to go to the main cashier. The main cashier now, that will be the person who is giving you the money, and is the one that is handling the main cash book. Remember, this amount will be reflected in the main cashier's records. So in this main cashier, it will be looking like as if it is a payment, but in the petty cash, it will come as an income, and it will be on the debit side. So the petty cashier will have to go to the main cashier to request for a reimbursement. Of course, the main cashier will only give you this 900, because this is the money that you have so far spent. Because every time you go for money, it will be just a reimbursement, just to top up to the position. So the main cashier will give you 900, and this 900 US dollars, if you add the 100 that you have, it will take you back to the 1,000 US dollars. That is the threshold you are supposed to be with. And that's where you will pay off this extra 200. So the main cashier will just give you the reimbursement, just to take you back to the main, to the original float that you are supposed to be with. And it will be from that original float that's where you will start spending again. Therefore, all the time the reimbursement, all the time when the reimbursement is done, it must be to bring you back to the original float. And that's what we are trying to say. And we will not say that since you are coming back, maybe you are coming before the month ends, then you are going to be given the difference. Because it is very possible someone might look at it in a sense that, since this person, because now this next transaction is still within the month, maybe it is the extra transaction that is remaining for the close of month to come. And you are seeing that this amount, you have already spent 900, but you are seeing yourself the next transaction is 200. Someone may say that, why don't the main cashier just give you the 100, because it is the balance to offset this Then you close off that month, 31st Jan. Then in Feb, the main cashier gives you the total amount. That's wrong. And the reason as why it's wrong, it's because if the main cashier gives you this, and in the next month he gives you this 900, this, if you add the entire amount, this one will have exceeded the original threshold. It will be 1,100 US dollars. That will be higher than the original threshold. Even if you say that maybe since here you have exhausted the 900, this one, you have exhausted the 1,000, and maybe the cashier should in the next month should give you less because in the first month you exhausted. This one you exhausted and you went up to 1,100. So the other one could think that maybe in the month of Feb, the main cashier should give the pet cashier 900. So that when you add this plus this, it gives you 2,000 US dollars, which is for the 2 months. That's wrong also. Because every time the pet cashier goes for a reimbursement, that reimbursement should be for the expenses that have been paid, or that for you're just paying back the money that the pet cashier has spent, just to restore that pet cashier back to the original float. You need to take care of that, because if you don't, you'll find it in the question. Maybe we shall understand more when we look at the practical question, but that's basically what we are going to be doing. So the reimbursement is supposed to be bringing you back to the original float. And that's what this is all about, the interest system. So anytime the pet cashier comes for reimbursement, you will be given the total amount you have spent so far, and then you will be restored back to the original float. And that's basically the interest system. However, let me also tell you something, that in most of our organizations today, especially in Africa, now, what we have in Africa, or what we have done, is that we try to combine the pet cash. We try to combine the pet cash with the main cash book, and the main cash book. That's basically what we try to do in Africa. We try to combine the pet cash and then the main cash book. So what that means is that we combine the pet cash system with the main cash book system. Because if you try to look at some of the examples, of course, we have the government institutions. The government institutions, that's what they do. They combine the pet cash systems with the main cash book systems. So you find that their cash book system is the same as their pet cash system. So you find that these companies, you find them making all the pet cash and then the main cash expenses in the cash book. Everything appears, all the pet expenses and then the main expenses are appearing in one cash book, but they try to use what we call the analytical column. They try to use what we call the analytical column. As they combine the pet expenses and then the main expenses, they try to use what we call the analytical column to try where they are going to share, and they try to put the details of those expenses that they have incurred, just like categorizing the different expenses. And I will try to show you how that is done when I go to the format, because it's also a situation where you find that you get interests for the pet expenses as well as signing the main expenses for the cash, or the major expenses of cash. So some organizations try to combine, and then they spread the analytical column, but the right way to be done is to maintain a cash book for your major expense, and then you are also going to maintain a pet cash book for your minor expenses. That is the best way to do the things. You separate the pet cash and then the main cash, you separate. That's the best way, but most of the things that we do in Africa, we just combine and we spread the analytical column. But we shall have a look at that maybe when we come to the format. But the best option is for us to have the pet cash book and then the major cash book for both our minor and major expenses respectively. Because if you do that, you'll be given a float, and then you'll be doing it by the impressed system, and that's basically what the impressed system is all about. You'll be given the reimbursement for the expenses you have incurred, just to restore you back to the position where you were at the original float. So what I'm going to do now is I'm going to give you the format of a pet cash book, and then we will use it to take a practical question, because I believe that some of these topics we understand them by solving a practical question. However, before I give you the format or the layout of the pet cash book, let me also make you understand that the pet cash book also follows the double entry system. You have to understand that it also follows the double entry system. The pet cash book follows a double entry system where it has the debit side, and it also has a credit side. And the debit side, of course, this debit side will always have the receipts of cash. It will always have the receipts of cash, and then the credit side and of course most of the times the receipts of cash in the debit side is always the cash float or the float. It is always the cash float that will be always in the debit side of the cash book, because there we shall have either the cash float or we shall be having these reimbursements. So it is either an initial cash float or reimbursements of the amount that we have spent, and that's what is going to be under the debit side. And then the credit side of the pet cash book is for payment. There is a column for total payments. And over here, the payments are split into analytical columns, meaning we are trying to group the expenses under different headings, depending on the category of an expense that we have incurred. So in this, because we are going to have the debit side is going to have the what we call the payment side, the payment, but this one, the payment will always be in two different analytical columns. And these analytical columns will be showing the categories of expenses that we have. For example, we can have a column for postage. We can have a column for travel and transport expenses. So all the expenses that are related to transport will be within that category. We can have things to do with wages and salaries. That would be an analytical column. We can have a column for utilities. So that's how the analytical column, that the utility column will have all the utility bills. So what we are trying to say is that every payment that we make from the float we will have to record it facing the total payment column. And then we extend it to an analytical column to show that this payment is under this kind of category, so that at the end of the period, even though we are going to be getting the total payments for every category that we have, or that for every payment that we have made, then we are also supposed to get the total payments for every category of expenses, because we are going to find that we need to understand how much did we spend on transport and travel. Meaning for us, having known that the total payments were, let's say 10 million. But out of the 10 million, maybe we have a category of travel and transport, we spent maybe 2 million. Under postage, maybe we spent 1 million. Under salaries, maybe we spent 6 million or 8. Under utilities, we spent maybe 2. So that's how we are going to be getting. That's the reason as why we get these analytical columns. These analytical columns will just show the different categories. But all those analytical columns, they are going to be showing, or they are going to be under the payment. So these analytical columns are just sub payments that we've made, or subcategories that we've made under payments. So there are times even when we have also creditors within the analytical columns, because some creditors can be paid by using the petty cash book, especially when the creditors, they are demanding us very little amount of money and not a very huge amount of money. Because if the creditor is demanding us a very huge amount of money, then it means that creditor will be paid out of the major or the main cash book. So we might not have that appearing under the petty cash book. But if the creditor maybe is demanding us something very small, maybe the creditor has supplied us maybe some pens, 1 box of pen, we can pay that one out of the petty cash payment, because the amount is small. But if we have maybe a creditor that supplied us maybe billions and billions of shillings within maybe raw materials that we use in the manufacturing, then that is supposed to be paid out of the main cash book. So we can at some point we can pay off the creditors using our pet cash book, but there could be another column it could be a column or a ledger. But you just know when you put in the creditor or that creditors where you have paid them, it will also be under the total payment. It will be under the total payment column. And we are also just creating that as a different analytical column. We create an analytical column to show the creditors, but that should also be under the total payments column. However, the funny thing about this pet cash book is that, you know, when we talk about the cash book and then the double entry system, the debit side has its column for particulars, debts, particulars and debts for recording, and the credit side too will have its particulars and then the debts. But when it comes to the pet cash book, because that's mainly what is done under the double entry system, that you have the debit side. Under the debit side, you have your particulars column and the debt, maybe even the folio. It's looking like as if it is just a T account where you have the particulars and then you have maybe the date, the particulars, then the folio, and then the amount. And the same happens. This is the debit side, this is the credit side. But when it comes to the petty cash book, then it's different, because there is only one column for particulars and it is in the middle. And then we have only one column for the date. So these particulars and then the date column will cater for both the debit side, and at the same time it will cater for the credit side. So let's look at how interesting the petty cash book is. So we look at the structure or the layout. We've said we have the receipts, we have the folio, we have the date. I told the dates and then the particulars column, they are in the middle. Then we have the particulars. We can have what we call the voucher numbers. We can have vouchers. We have total payment. And now when you're done with the total payments, then you will split the analytical columns, where you can have maybe wages, they can be wages and salaries. We can have very many. So this one, they are still going. We can have wages. You can make each one of these as a column. Let me change the color. You can make a column for wages. You can make a column for traveling. You can make a column for postage. These are supposed to be added this side. You can also make a column for cleaning. You can also make a column for creditors. You can add as many as you want. All these are supposed to be represented by column, a column. They are supposed to be this side. You put all of them there. So we have the receipts column, and this receipts column for the debit side, and then we have the column for ledger folio. This is a column for ledger folio, and I told you that the ledger folio is more of a reference. And then we have a column for the debt. That's where we put the debts. And then we have a column for particulars. And that would be the debit side of the cash book, of this pet cash book. Now we have another column for, this is vouchers. If you don't call it vouchers, you can put maybe voucher numbers. And also have a column for total payments. And finally, we have, these are the analytical columns starting from here. All these are supposed to be columns. Those are the ones that we call the analytical columns that we'll be following. So we can add maybe 4 extra analytical columns depending on the question. Depending on the question that you are going to do. If let's say it has 4, the 4 analytical column, of course, this first one, the one for wages, then the traveling, the postage, and then the cleaning. This one, the creditors column, is not an analytical column, but it's a little bit different, because it will not be analyzing, it will be just paying off some creditors with small payments. So because that we have indicated that we have shown maybe 4 analytical column, then another column for the ledger folio, and the last one will be for creditors. Because you see under creditors, this column here, we might also have a small ledger column or ledger folio. But that one I will explain a little bit maybe later. But just know this, you add extra analytical columns, then if they are because now sometimes the creditors may not be there. If they are there, the ones with the small payments, then we can also show that creditors column. But just know we have these columns, these ones, and this one, then we add other analytical columns. So let's look at the debit side with the receipts. Of course, now the debit side, we always put in the amount that is going to be given to us as let's say the cash float. That is the initial float that we have. The receipts Of course, the receipts here will put the currency. If they are going to be in US dollars, Ugandan shillings, depending on the currency that you are working with. So the first column, that will be the receipts side or the receipts column, and then we have the ledger folio with another column for date and then the particulars, or what you can call the details. If you don't call it particulars, you can call it details as well. But when you're looking at the pet cash book, the debit side is this left hand with receipts folio. This will be now the debit side. This one, the left hand side. Basically, that will be the debit side. Then the credit side, of course, will be this side, which has the payment side, of course, will be the debit side. The credit side of the pet cash will be now the payment. This is now the payment side. The payment side, of course, we start with the voucher, this voucher number, and then we also include in the total payments, these two columns. This one. Within these two lines, these are the payment. The payment side, or what we call the credit side. I told you this date and particulars, they are always in between. So the credit side of the petty cash is just the voucher number and then the total payment. That is the credit side of the petty cash book. Now, this particulars column, the particulars column and then the dates column, these are the ones that are in the middle. As I told you, that is the difference that we use. We have only the date and then the particulars once, even though it's a double entry system. So this means that when you are recording on the debit side, then you will use the same particulars and then the dates column. And also when you are recording on the credit side, then you will also use the same particulars and then the date columns. And that's the interesting fact about the petty cash book. However, the whole petty cash book ends at the total payment. What you have to understand is that the whole cash book ends here. The petty cash book moves from this to this point up to the total payment. This analytical column is not always there. The petty cash book ends at the total payment column, such that these voucher numbers and then the total payments column will represent the credit side, while the receipts and then the ledger folio on the left hand side columns will be representing the debit side of the petty cash book. But the date and the particulars columns are in the middle, where they cater for both debit and the credit side of the cash book. So this is where we have the petty cash book has this receipts folio. That is the debit side. Then we have the credit side, we have the voucher numbers and then the payments. Because when you're paying, you pay through the voucher numbers, payment vouchers. Then what is in the middle here will be the date, and this date and then the particulars column will be representing or will be catering for both payments and the receipts. But when we come to the credit side, because I have told you that total payment, this total payment column here, will be recorded this total payment will be recorded, but we will need also to extend the payments under their various headings or categories. And we will be having a lot of categories or headings when we are where we are going to create the category totals for each, because these total payments, as I told you, as we write the total payments, we need to know that these payments we have incurred, we can say maybe under transport costs, we have incurred maybe 10 million. But the question is, how much did we spend on business-related transport costs? Because within the transport cost, we may have costs that were included, but they were not maybe generating income for the business. So that's why we need to have those different categories to highlight the category totals that under transport we summed up such and such amounts to be able to total up that total amount that we have shown under the payments column. However, I also want to explain something to you, that most of the questions may decide to give you the headings, the category headings that are belonging to the different analytical columns, or what we call the category columns. And then the examiner might tell you that you group such expenses in such headings or such categories. But if maybe the examiner has not given you these categories, then the examiner will expect you to use or form your own categories or headings, so that you can look at your headings of expenses and then you create your own headings depending on the different expenses that they have given to you. Although in most cases, organizations, there are account heads, the account costs, and there are already established headings that will be used. And whenever you see a transaction that belongs to a particular category, then you put it or you put them together. And that's basically what we will be doing when we are doing any petty cash book number. Because as I told you, in some organization, well-established organizations, they always have what we call account costs. They always have costs that they will incur or that they are going to use. These are basically the categories of costs. The categories of costs that they may incur within an organization. They may have maybe, for them, if let's say you incur transport fare, for them they may categorize this as maybe travel expenses, not even transport costs, but they are categorizing them as maybe traveling expenses. So each organization, depending on the industry, they have some accounting costs or some categories of costs that they use as their headings. So they always have those account costs or account categories. So any transaction that you incur, if let's say you incur transport fare, you find yourself categorizing it under traveling costs. But this traveling costs is already established within the organization. So that's what we call the fact that some organizations have account costs. Now, there could be more analytical columns, like maybe travel and transport costs. Others may have, you may have something to do with the travel and transport costs. That anything, transport costs or transportation costs. So anything that is relating to transport or transporting whichever item, whether raw materials, whether what, whether finished goods, whether anything, they can categorize it under transport and travel costs. So this will be the account category. They can also categorize costs according maybe to sales and marketing, or sales and advertising. They may also categorize costs maybe finance and administration. They may also categorize costs based on maybe research and development. So they can use any category to categorize the costs that they have in the business. So we may have different, and each of these categories is going to be representing a column, what we call the analytical columns. Analytical column is just giving us the detailed costs that we have incurred in each and every category. So you will see that in each analytical column, we have costs that are related to each other. If they are relating to transport, they are all relating to transport. So there may be very many analytical columns, but these last two columns to the folio, the one for folio and creditors column, these will not always be the case, because in your question, the examiner might pay, or you may find that in the question, the examiner is not paying creditors, or the examiner is paying creditors. So it will all depend on the question. But that one you can, until maybe you have seen a question that has that, but otherwise you can ignore most of the times if the question doesn't have such items. But these analytical columns will always show. However, the specific analysis column, in other words, the categories, cannot be determined yet because you can't just determine until you have seen what the question, like you can't predetermine the analysis columns. It is better when you have seen the question and you know how many analysis columns you are going to have, but you can't predetermine them. So that's why we are assuming that maybe you can have, depending on the question they have given to you. So the analytical columns will always be dependent on the question they have given to you. And the other thing that we need to emphasize is that the ledger folio and the creditors columns will only show when the question has things to do with paying creditors. Either they might be companies, or they may be human beings that you are paying off as creditors. But as I told you, that the constant ones you should know are the debits and then the credits, where the date and the particulars columns are in the middle. So they are supposed, these two, they are in the middle because they are supposed to cater for both the debit side and then the credit side of the petty cash book. So without wasting much time, let's now maybe try to look at a simulation, look at a practical question, and we try and solve it together so that we can enhance our understanding. So let's look at the simulation. Simulation. From the data given below, prepare a petty cash book. Prepare a petty cash book for Zombo Enterprise. For Zombo Enterprise for the month of August 2018. For the month of August 2018. For the month of August 2018. So we are starting with August 1st. On 1st August, the cashier gives US dollars 4,000 as float. To the petty cashier. Full stop. They are continuing to say that payment out of petty cash during August so they have given us payments out of petty cash during August, and they are in US dollars. So they are listing all these. On the 2nd, we had wages, and the amount was 300, but remember all these are in US dollars. What happened on the 3rd? We had traveling expenses, and the amount was 150. On 4th, we had the postage of 100 US dollars. On 5th, we had the traveling expenses. Traveling expenses of 100 US dollars. On 9th, we had the cleaning expenses of 50 US dollars. On 10th, we had wages of 200 US dollars. On 12th, we had the postage we had the postage of 150 US dollars. Then on 14th, we had the traveling expenses. Traveling expenses of 250 US dollars. On 16th, we had the cleaning expenses. Cleaning expenses of 100 US dollars. On 17th, we had wages. Wages of 180 US dollars. Then on 20th, we had the postage. Postage of 200 US dollars. On 22nd, we had the cleaning costs. Cleaning expenses. Cleaning expenses of 150. On 24th, we had the traveling expenses. Traveling expenses of 300 US dollars. Then on 26th, we had the settlement. Settlement of Robert's account in the purchases ledger. In the purchases ledger, and the amount was 450. Then on 27th, we had the postage of 150. On 28th, we had the cleaning costs, cleaning expenses of 80 US dollars. Then on 31st, they told us the cashier reimbursed the petty cashier the amount spent in the month. The cashier reimbursed the amount that was spent by the petty cashier in the month. So they want us to prepare a petty cash book for Zombo Enterprises for the month of August 2018. Now, what you can see in this question is that most of the transactions keep on repeating themselves, because you can see, for instance, we have here, we have cleaning costs. If you look at these cleaning costs, then the account titles keeps on repeating themselves. So if you try to check for cleaning, you can so here on 22nd we have cleaning, on 9th we have cleaning. So the expenses keep on repeating. Even here on 16th we have cleaning. So these expenses keeps on repeating themselves. So it means they kept on paying these expenses. They had wages. Maybe they were paying, wages, they pay you as you have done the work. You've seen here they paid, here they paid also wages, and also here they paid wages. So you can see the expenses. Even here, traveling expenses repeating, even here, traveling expense. So the expenses are repeating themselves. That's one first thing that we have identified. So once you have identified that, that gives you a clue that the analytical columns will be trying to have all these expenses classified or categorized under one similar transaction or under the same category or heading. And those different categories or headings are the ones that we call the analytical columns. And that's where we get the name. We get the name called that's why most of the times we call this the analytical petty cash book. We call it the analytical petty cash book because we keep analyzing these costs and we keep on categorizing them into different cost heads. So this question is very simple and very basic. It's a very basic question as far as petty cash book is concerned. And we are also told that the reimbursement, they told us on 31st that the reimbursement, the cashier of the business reimbursed the petty cashier for the amount spent during the month, meaning that the reimbursement happened at the end of the month because 31st is the end of, it happened at the end of the month. So reimbursement was done at the end of the month, and that's what we wanted to cover as far as part 1 of this video lecture is concerned. But we shall look at part 2 of the same video about petty cash book, where we shall look at we shall be taking a situation where, of course, the months, the money, like within the month, the money got finished and the petty cashier had to go for reimbursements within the same month. So we want to see how we treat that. So the next question will be to solve, but of course that will be in the part 2 of this same video lecture, where we shall talk about when the money is finished and you need to stop your expenses so that you first go for reimbursement and then you come back and you continue with the same spending within the same month. And in such questions, nobody will tell you that you go for reimbursement. But as you continue making entries, you will be calculating how much is being spent in total. And if you are not careful, most of the times you will find yourself exceeding the float. And for you will keep on writing without knowing that you actually bypass the float. Because you need to know the point when you are supposed to go for reimbursement, and the examiner will not tell you. Otherwise, if you keep recording, you will reach at a point where you are supposed to go for reimbursement, and the examiner will close whatever proceeds if you don't go for reimbursement. But we shall learn how to do that in part 2 of this video. However, in this very question, we have been given a list of expenses to be paid, and we are told that it was at the 31st that they went for reimbursement, meaning that the money never got finished within the period. So the implication is that the money that was allocated, the 4,000 that was allocated, 4,000 US dollars, was enough to cater for every expense that was supposed to be paid within that period. And that's all we are going to do. So we are going to solve this question very quickly, and then we move on to the part 2 of the same topic, petty cash book, where we are going to be looking at our questions where we shall have to go for reimbursement during the period. So now we can see the solution. I've shared what we are supposed to do. And you can see that we did the question. Now, so this, we are going back to our question for Zombo. The transaction that happened on August 1st, they told us the cashier of Zombo Enterprises gave the pet cashier of the same Zombo Enterprise $4,000 as float. We say the float, a cash float, is just the amount, the initial amount the petty cashier is given to cater for the petty expenses. So we are now going to record the float, and the currency they told us is in US dollars. We've seen we have both the receipts column, and then this is the receipts column, and this is the total payments. They are not all that visible, but you can see the columns that we have. This is a receipts column. This is a folio column. This is a date. This is particulars. This is voucher number. This is total payments. Then now starting from here, this is where we have the analytical columns. We have a column for wages because we have seen there are so many wages that were paid. We have traveling expenses. We have, this is postage. We have cleaning, and then the final part is the creditors, because we have seen there is someone that was paid. So that's basically what we have there. So we need to first record the float, and we say the float will be our receipt. That's the money we are receiving, and we have indicated it here. We have indicated it here under the receipts of $4,000. It is debited because we told you this is the debit side. The debit side has these two things. It has the receipts and then the folio. Then the credit side of the pet cash book has these voucher numbers up to the payment. These two. It has the voucher number and then the total payments columns. Then these two, the date and the particulars that are in the middle, they are those that are going to be shared by both the debit column and then the credit column of the pet cash book. So we record the first transaction supposed to be debited in the receipts column. So we shall come to the date. Of course, we come to date. We write 2018 August 1st. Then we write this side on the debit side, which is the left-hand side. We write the 4,000 under the cash, under the receipt C column. And the particulars, we are going to call it cash or a cash float under particulars. Where can we find this amount? Remember, this amount was given to us by the cashier of the business. So it's supposed to be reflecting in the, main cash book. That's why in the ledger folio we put cash book. We can use C/B to represent cash book. Maybe it is a cash book 001. Because it is going to be reflecting in the main cash book. That's where that line item is going to be. It will reflect the other side as a payment. The other main cashier is going to record as if he paid this pet cashier this $400. That is the implication. The other side, it will look like a credit, a payment, but this side we treat it as an income because that's the money we are starting with. So that's it. We are debiting it, and we are calling it cash over here in the particulars. And we are debiting it because the corresponding entry will be in the credit side of the main cash book. Therefore, when the main cash book releases a float, of course, the main cashier, the other cashier, when he releases the float, is going to be crediting the petty cashier, the petty cashier. Then the petty cashier, in the books of the petty cashier, we shall be debiting that amount. But it should be in the names of cash. And in the main cashier's book, it will be in the names of petty cash. And that's the meaning. So therefore, it will be cash under particulars, but the amount is $400, which will be written in the debit side of the petty cash book. And the ledger folio will be the cash book, the main cash book, where the money is. So we can also put maybe the ledger folio 001, depending on how many cash books that we are running, the main cashier is running. And that's how to receive cash as a float from the main cashier before even you start making off the payment. So let's look at the next transaction. We are going to look at few transactions, then we shall conclude. Now, let's go to the payments. Because they told us the payments, they started the payments on 2nd August. And the first payment was wages of $300. Now, the transaction happened on 2nd. In the particulars column, we write wages. Now, maybe this is voucher number 1, because this is, we may call it voucher. We can give it voucher number 1, voucher number 2, voucher number 3. But if there are very many things that we are going to pay, we analyze them as vouchers. So you keep picking voucher. We can even just say 001. We just know that is voucher number 1 that is relating maybe to wages. Now, in the particulars, we've said we are going to put wages, and the date is 2nd. Then you, after writing wages in the particulars, and then the amount is 300. The total amount is going to be in the total payment side. And this same $300 will be recorded under total payment, because that's the money we actually paid for the wages. From there, you write an analysis for which this transaction relates to. This transaction, it is supposed to be within the wages column, the same amount 300 that happened at that date. If it was under maybe traveling, then we would have put it under traveling. So this wages is relating to wages column, or wages column as the analytical column. So these other ones, we don't put anything. We go to, now, when we are done with that, so sometimes you may find that maybe if you are given and this wages was maybe called wages and salaries, the category might be wages and salaries. Maybe you have also other salaries. If we see maybe in here in the expenses, we have some salaries. We can call it this heading, the analytical column, to be wages and salaries. So we are putting the wages in its own analytical column or analysis column. Then you can extend that same amount to the wages column, and that's what it means. So even though each expenditure is given is going to come to this amount, this total expense, the total payment, even if it is just one transaction, it has to reflect in this analytical column where it can go in its respective heading. So we move it under its own heading, whereby we are grouping it, and that's basically what we call the analysis. And generally, that's why it is called analytical petty cash book. However, every payment is being made by a payment voucher, practically in the office, because we make payments by payment vouchers, and every payment voucher has a payment voucher number, and the payment voucher number must be written under the payment voucher column of the petty cash book. So that's why we assume that maybe the payment voucher number was 001. Maybe the next one will be 002. Now let us look at the next payment, which is on the 3rd. That is traveling expense of $150. So on 3rd, there was a traveling expense. Let's say it is voucher number 002, which is 150. But this traveling expense is different from wages. So we cannot put the traveling expenses under wages. So you will have to create another column for traveling expense. So you are seeing this one is a traveling expense. That is a traveling expense column as one of the second analytical column. Because it is the traveling is different from the wages, we can't put it in this column, the first column for wages, the first analytical column that we created. So what we are going to do, this transaction happened on 3rd. We record it under date. In particular, as we put traveling expenses, we assume that it is payment voucher number 002. That is what we included here. Then the total payment that we paid is $150. But this same $150 has to appear in the same traveling expense column under the analytics columns. So we put it there. Then these other columns we put nothing. Remember, we create this analytical column on a step by step. So these ones are not yet drawn. So we started with this one. Now we are now on this one, the one for traveling expenses. So we are done with that. So under the analytical columns, we are now having the wages as the extended to wage column. We have traveling expense, which will be extended to the traveling column. And basically, that's how we go about this analytical petty cash book. The next one, or the next transaction, is on 4th. The next transaction, so it is on 4th. So we record under the date column, we record 4th. What is the transaction? It is called postage. So we write under particulars, it's a postage. We can call it payment voucher number 3 under the payment voucher column. How much did we pay? We paid $100. We included it under the total payment. That is the total amount that we paid. But that is under a new category for postage because we can't put that 100 under wages or traveling columns. We have to create another column called postage. So once that is done, we include that same amount in the same line or on the same date. So we have recorded that total amount as $100, which we can call voucher number 3. Now we can see that the postage cannot be under the wages or traveling expenses as the category. So we created another category for postage. And that's where we put the same $100 in the postage column in the same line. So as long as you have different category of expense that you have paid, then you have to create a different column so that it can be extended. And that's the meaning of the petty cash book. It's only the easiest, it is actually one of the easiest topics in accounting. So you should just pay attention and we'll be able to sort it out. So as long as the expense is different, you go ahead and create another analytical column. Now, the next transaction is on 5th, and that is traveling expense. We have also had a traveling expense. So this is the traveling cost, the traveling expense. Remember, these transactions, we are recording them first hand. So what we do, since we already have traveling expenses, we record it on 5th that we incurred the traveling expense, and we create a different payment voucher, because these ones, once the date has passed, it means those transactions are now done. The moment you have anything new to pay, even if it is the same payment, if let's say you are paying wages, casual workers have come to work today, the same casual workers will come to work tomorrow. It is the same thing. The voucher number that you have when they have worked today, it will be a different voucher number when they come to work tomorrow. That's why even here you are seeing that we have this as payment voucher 004, and the amount is 100,000. Now, since this is a traveling expense, under the analytics column, we don't create another column because we already have a traveling expense column as a category. So what we just do, we just create that amount in there. So the implication is that when you are at the end of the day, you will be adding up that I paid $150 on 3rd, and I've now paid $100 on 5th. That means I've so far paid $250 as traveling expense for the 2 days. So at the end of the month, someone is going to ask you, how much have you incurred on traveling expenses? So you will just add up the traveling column. I hope now we are seeing the reason as why we have these columns. This same amount will reflect in the totals, but these columns will give you an analysis of the different category expenditures that you have incurred. So you've seen that so as long as it's not a different account, we don't create an analytical column. That's what you need to understand. So we are done with that happened on 4th. The traveling expense. So the traveling expense of 100, we still brought it under the traveling expense column. so that at the end of the period, we add up every column to know the total expenditure that we have made under each and every category before we can look at the total payment, the overall payment that we have paid in that month. Now, that's how we are going to be repeating these transactions. So your exercise is do the rest of this, because my main emphasis is to show you what happens after you have put in all the entries. So that's basically what we are going to look at. What happens after you have put all the entries there. So we just want to look at when we are adding up the things. We want to look at the end of the period. How do we balance off? You can see how the things were done. So my emphasis is at this bottom side where we are closing off the account. Now, once you are done with the transactions for the payments and you have recorded each and every item that was there, what you have to do is now looking at the reimbursement of the costs that we incurred as at 31st August 2018, because that was the year they gave us in the question. Now, to do this, we are supposed to balance off these accounts, because when you have posted all the entries, you need to balance off. But balancing off is more of trying to know how much the cashier should be reimbursing the petty cashier. So you need to be very careful when we are balancing off this, so that you can be able to know what exactly is done, especially for reimbursements. Now, we are going to find the totals of both the debit side and then the credit side. And when it comes to balancing off, then I want you to first look at both the debit side and then the credit before you think about these other analytical columns, because there is no balance brought down and carried down within the analytical columns. For them, they are just totals only. We just put the totals only. The balance brought down or the balance carried down is only within the debits and the credit. I told you that the credit has the payment voucher numbers and then the total payment. Then the left-hand side is where there is the debit side, where we have the receipts and then the folio, ledger folio. So now let's balance off. So what we need is to balance off the debit side and then the credit side. And when we add up all these total expenses or the total expenditures in the total payment column, this column, when we add all these that are here, in that we've incurred for all the different days in the month of August. You can see that it's giving us a total of 3060, meaning it is 3060 US dollars. That is the total that we spent, the total payment within that month. But now we were given 4,000 US dollars, meaning you get the 4,000, you less off this. What do we have as the balance? So we are given, the cashier gave us 4,000 US dollars and we spent 3,060 US dollars, and this means that we only need a reimbursement. This is the reimbursement that we need, the reimbursement. Because they told us they always reimburse what we have spent in the month. So once they give us this back, we shall be able to go back to the total float of 4,000 US dollars. So the best thing to do here is to make the 4,000 US dollars the total for both sides. So you are seeing this one is 4,000 US dollars. So we make the 4,000 to be the balance, the total for both sides. And now the balance carried down. The balance carried down will appear on the side that has the smallest amount. We balance it as usual. So when you get the 4,000, now, as I told you, you need to make this 4,000 the total. Once you make this 4,000 the total for both sides, it means this side, the balance carried down will be on the payment side, because the payment side has 3060, but this receipt side has 4,000. So there is that difference. Now, you will find that the balance brought down will actually be on the credit side of the petty cash book. So the balance brought down will be on the opposite side, meaning the balance brought down will be on this side, the receipt side or the debit side of the petty cash book. And when these reimbursements of the 60,000, this one, when this reimbursement comes and it is given to the petty cashier, they will add this reimbursement plus the balance to make sure that we go back to the total float of 4,000 US dollars, and that will equate the full cash float that we started spending, because that's the money that we shall be having for the next month, that is September 1st. That's the money that we will be having for spending. However, our question was specific that they wanted us to take the reimbursement before the period ends. You need to be very careful here. What I have just explained, that's what you would have done if the reimbursement was supposed to be maybe if the reimbursement was supposed to be paid maybe after the period. But remember, the reimbursement was before the period ended. It was on the same date, on 31st. That's when the reimbursement was made. So how do we handle that? Because they told us we shall take the reimbursement on the 31st. The same day that we are closing off our account is the same day we are taking the reimbursement. So we are not taking the reimbursement on 1st September. We are taking it before the period ends. So the implication of us taking it before the period ends is that by the time we go on September 1st, we have the whole amount with us. Therefore, on the 31st, we shall record cash of 3060. This is what we are going to do. Oh, that's how, this is what the examiner wanted us to do this. The implication here was, the question told us that the money was picked on 31st. The reimbursement was done on 31st. So it means on 31st, we are recording cash. That is the cash you are seeing here on 31st. And this cash is coming as a debit. It's under the receipts because we are receiving what we spent. And since we are receiving what we spent before the period ends, then we need to close off the accounts. So the 3060 is supposed to be on the debit side of the petty cash book under the receipts column to show a reimbursement of the exact cost that we have spent, and then we can finally balance it off as usual. So now we balance off as usual. How do we balance off? So the balance carried down will be now the 4,000. Why? Why are we going to have the 4,000 as the balance carried down? It is basically the balance, because we had this. We were given 4,000 at the start of the period, and we were reimbursed 3060. This is what we have. This is what we have here, and the first one that we had up here. So once you add this, it is 7060. But remember, we have so far spent 3060. So it will be the 7060 minus the 3060. And that will give you a 4,000. So it means at the start of September 1st, we shall have 4,000, which is the same cash float that we are supposed to be with. I hope you are getting what I'm saying. The balance carried down will be 4,000 because here we have received the reimbursement. So this one increased. This one increased. This is what we have so far spent. So it means if they have reimbursed us this amount on 31st, it means the total amount that we have is 7060. That is going to be the total for both the sides, 7060. So the balance carried down, because this side is smaller, this side, once we added all this, was giving us 3060. So we get 3060 minus the 760, we remain with 4,000. That will be the balance carried down on the credit side because the credit side is smaller than the debit side. So here we shall have the balance brought down, but this balance brought down will be this side you're seeing on the debit side. That's why you're seeing this amount here, 4,000, and it is on the date of September 1st because that is the money that we have at the beginning of the next month. That's the money we shall start with at the start of September. So the debit side was having 7060, which will be the total for both sides. And then the balance carried down will be, the balance carried down will be 4,000. And that's the same amount that will be on the balance brought down as of 1st September. And that's basically how we do the balancing off if the question says that we received the reimbursement before the period. And finally, for analytics columns, we just have to add up the total for all these columns, and then you show their totals for each and every column. So what we need to look at in the part 2 or in the lecture number 2 of this same video on this same lecture on Pet Cash Book, we need to look at something that is not a little bit straightforward, because this one was a little bit straightforward, but we need to look at expenses when maybe we have incurred an amount and we have exceeded the cash throat within the period. Hello viewers, welcome back to our YouTube channel, and today we are going to continue our study on the Petty Cash Book, and we are going to take a question that will involve the reimbursement. We are going to take a question that will involve the reimbursement at the end of the period. The reimbursement at the end of the period. That will involve the reimbursement at the end of the period or at the end of the month, because in the previous video lecture we did what we did was that we took a question that was having situations where the reimbursements was done before the period. So in that previous video, we explained to you that when you are spending your interest, or what you call your float, when you are spending your float or the interest, when you are spending it within the month and the float gets finished before the end of the month, then you go for the reimbursement and then you continue spending. Therefore, what we are going to do today is that we are going to take a practical question and we try and solve together. But you have to take note that this question involves reimbursement within the month. And what is going to happen is that when you are spending your money and then as you continue spending that money or that the cash float within the month, and then you keep on accumulating the amount that the amount spent. So as you keep on accumulating that amount, you want to be sure that you are not overspending. And when you get to the point where the balance of the float that is left in your hand cannot pay off the next expenditure, then you'll have to first pause and then go for a reimbursement before you continue spending. So that happens in a situation where maybe you find that maybe you've been given 1,000 US dollars as your cash float, but you find that you have spent maybe 800 US dollars. But the next expenditure is going to cost you, let's say, 300 US dollars. If the next expenditure is going to cost you 300 US dollars, if you will see that what is left, because your cash float is 100 US dollars and you have seen that you have already spent 800, meaning you are only left with 200 US dollars. But the next expenditure is 300 US dollars. So you are seeing that the balance you have that is left on your cash float is not enough to cater for the next expenditure. So once you realize this, you have to pause spending and you first go for the reimbursement. And the reimbursement would be the reimbursement of the amount you have so far spent, which will be the 800. Once they give you this 800, you add the 800 plus the 200 you still have, that which was the balance on the cash float. Then you go ahead and spend the 300 from, because now once you add the 800 plus the 200, it will take you back to the cash float of 1,000. So once you spend the 300, you'll have a balance of 700 US dollars. That's exactly what we are going to be doing. So what will happen in this question is that the question will not, or the examiner will not tell you, or will not even mention that at this point you are supposed to go for reimbursement. But they will just continue giving you the list of expenses that you have to pay for. But it's up to you, the student, that as you continue spending, you keep on calculating how much you have so far spent. And as you keep on accumulating that amount on your calculator, so that you see that if you have a float of, let's say, 100,000 or 1,000 US dollars, then you can keep checking your expenses that you have kept on spending. Maybe your first expenditure was less 100 US dollars, because you may find that maybe your first expenditure, if the cash float is, let's say, 1,000 US dollars, but you find that maybe your first expenditure, the first expense is, let's say, 100 US dollars. 100 US dollars, and maybe the second expenditure is, let's say it is 500 US dollars. And that would mean that the total expenditure that you have so far incurred is 60 US dollars. So if the first expenditure is 100 and maybe the second expenditure is 500 US dollars, that would mean that you have so far spent 600 US dollars. And now, because now you will see that this is the total expenditure so far, meaning that the balance will be 400 US dollars. Now, if you realize that maybe your next expenditure is, let's say, maybe your next expenditure is, let's say, 300. Let's just use 300 US dollars. If your next expenditure, the third expenditure, is maybe 300, then that would mean that you have so far spent the 600 plus then the 300, that would be 900 US dollars for all the three payments that you have made. So you keep on accumulating, meaning you'll have a balance that is left on the cash float of 100 US dollars. So therefore, this means that if your next expenditure is, let's say, if your next expenditure is going to be maybe for 200 US dollars, you will see that this 200 US dollars that you are going to spend, you don't have it. You only have 100. So this will imply that the 100 that you have or you have left with cannot pay off your next expenditure. And what you do, you pause spending. You pause spending and you first go for reimbursement. And what is going to be reimbursed is going to be the cost that you have so far spent. You are left with 100, meaning you have so far spent 900 US dollars. So the cashier will give you the 900 US dollars, just what is enough for you to go back to your cash float of 1,000. So you add the 100 plus then the 900, and you will go back to your 1,000 US dollars. And then from there, you will continue spending. So you will get this 100 minus the expenditure of 200, you'll have a balance of 800 US dollars. So that's how you do. You continue spending after going for a reimbursement. The whole idea is that you are not supposed to overspend. So it's not that you are supposed to keep on spending and you wait until the end, maybe the month ends, so that you can go for reimbursement. However, in reality or in office practices, it's not likely to overspend, because when money is going out of your pocket, you will know that it's now finished. But in an examination questions or in an exam situations, the examiner will just give you expenses. But for sure, as you know, because if the cashier has given you maybe 1,000 US dollars, the moment you keep on spending, you will just see that the money is actually finished. But for the exam, the expenses will just be written there. And remember, they don't even tell you that at such and such point, you are supposed to go for a reimbursement. So you might keep spending and then you overspend. So you have to take note of that. Because as I told you in the exam, they are going to list all the expenditures and they will not tell you when you're supposed to go for reimbursement. So for you may continue to enter the payments as if cash is there. So if you're not careful, then you might find yourself overspending. And then from that point, the moment you start overspending, from that point, the examiner will just cross that. The moment you don't, the cash float is finished and you don't go for reimbursement, then you'll find that whatever you have done up to the point where you're supposed to go for a reimbursement will be marked wrong. So without wasting more time, maybe let's try to have a simulation to enhance our understanding. So simulation says on, use another color. On Jan 2020, a petty cashier was given a cash float of shillings, a cash float of, these are US dollars, $900 for the quarter. For the quarter ended 31st March 2020. Full stop. Reimbursement was made as and when necessary. Full stop. They are continuing to say that expenditures incurred for the quarter are as follows. They started on January 3rd. Semicolon, we have traveling expenses of 120, those are US dollars. January 7th, we had postage charges of 84. January 8th, we have napkins 85. January 9th, we have tax. This is a taxi fare. These are transport fare. They were 88. Now the second month was Feb 3rd. We had stamp duties of 150. Feb 10th, we had tax fare of 85. On 11th, we had envelopes. Envelopes 164. We had on 14th, we had postage charges. There were 36. Then on 17th, we had soap for cleaning, 59 US dollars. On the same day, we also paid tax fares. Tax fares of 241. Then on 27th, we had napkins. On 27th, we had napkins, 109 US dollars. Then March, we went to March 9th, we had petrol of 189. We had cleaning, 55. Then at the same time, we also had envelopes. Envelopes 22. Same date, we also had postage charges of 30. Then on 25th, we had detergents. Detergents of 89. Then they are continuing to say that you are required to prepare Part A. They wanted us to prepare an analytical petty cash book. Analytical petty cash book for the quarter ended 30th March 2020 with the following analytical columns or analysis columns. With the following analysis columns, then we have semicolon. They have put for us traveling, stationery. We had cleaning, and postage. Then Part B, they want the ledger accounts. They want the ledger accounts. So that's our Part B. So these expenses or these payments or expenditures that we have been given, they were made in a quarter, one of the quarters of 2020, one quarter of 2020, and this ended 31st March 2020. A quarter is 3 months, because it would be 12. Those are the months in a year, divided by 4. That would give you 3 months. So it was from Jan to March. So when you look at the requirement in part 1, they required us to prepare an analytical petty cash book for the quarter ended 31st March 2020 with the following analytical columns. They gave us the analytical columns of traveling, stationery, cleaning, and postage. Then part B of the question is to post to the relevant ledger accounts for the expenditures that were incurred. And then the cash account, and that's basically what they want, what we are going to do. So what we are going to start with, we are going to draw the format first of the petty cash book for the columns that are involved. Then we are going to make our entries, and we are going to do this. We are going to do this question together. But what I have done, I have put the format for you here, because we have already looked at the format. We have seen the debit side has the receipts column and then the folio. We also have the date column. Of course, the date is going to be within the year of 2020. So we also have the particulars column. These are always in the middle. So the credit side is having the payment voucher numbers or the payment voucher column, and then finally with the total payments column. And once we are done with that, then we shall have this analytical column added, the different analytical columns as they gave us their subheadings. So we have already been given the analysis columns from the question. So from here, we don't need to look for this or form our own analytical columns, because they told us we have traveling, we have cleaning, we have postage, and then finally stationery. Those are the analytical columns that they gave us in the question. However, in this question, as you can see, there was no payment to creditors, and we have so since we don't have any payment to creditors, then it means there is no need for us to create the ledger column plus the creditors column. So we only do what they have asked us to do, or basing on the information that they gave us. So we start with the heading. The heading is, of course, we start with the name of the company. Of course, whenever we are writing the title, you always start with the name of the company. Name of the company first, followed by the document you are preparing. For this case, we are preparing a petty cash book. A petty cash book. And finally, followed by the period. This is as at, or for the period. For the period ended, or for the quarter, because this time they mentioned the period. So instead of saying for the period, can say for the quarter. Quarter ended 31st March 2020. You put always 3 lines. First, showing the name of the company. The second, which document you are preparing. Then the date for which period. I hope you have understood how you write the title of whichever document you are preparing. So it is a pet cash book as of 31st March 2020. I told you the format we start with the receipts folio that will complete the debit side of the cash book, of the pet cash book. Then you have the date and the particulars. These will be in the middle. Then the credit side will start from the voucher number and the total payment. This will be the credit side, and whatever that comes next will be analytical columns. And they had given us the names. They told us we have traveling, stationery, cleaning, and then finally postage. We don't have creditors. We've not paid creditors, so it means we shall skip the column 4, ledger folio, and then the creditors column. So let's start now feeding in the information. So when you look at the question, we were told that the pet cashier was given $900 as float. That is the money that was given. So it means that this is all that we are going to be working with. And we are given this money on the 1st of January 2020. And we are doing this pet cash book for a quarter. So there are 3 months that we are supposed to work with, because all the information, that float was given for the entire quarter. Now, let's try to record the float. The float that was given to us, it is supposed to be on the debit side of the pet cash book in the receipts column. So we have put the 900 here. But this 900, it's coming from the main cash book of the business. So the ledger folio, we are going to have cash book, maybe cash book 001 or 002, depending. So this cash book, we use the cash book CB001 in our ledger folio to show that it is coming from the cash book. So it is the cash book, and we have also given 001 as the page number. And that's the first transaction that we wanted to make. So when, of course, before you begin any pet cash book number or cash book solution, you first record your float, cash float, that you have been given or that you have received as unimpressed. And that's basically what to do first. And after that, we can go ahead to look at the expenditure, because you can't start by spending the money that you don't have. So you first record the money, then you start spending. So you have seen we received this on January 1st. Particulars, we received the cash. And that's it. Then we go on the payment, we start spending. Now they told us on Jan 3rd January, we had some traveling expenses that was paid of 108. 108 as traveling expense. So we paid on Jan 3rd, we paid the traveling expense. Maybe this was payment voucher 001, but the total amount was 108. So it is supposed to go into the traveling column with the same amount. Then these other ones, they are supposed to remain vacant, because the analytical column where the traveling is supposed to fall is supposed to be falling under the category for traveling. So what you have to be very careful is this with these voucher numbers is that they are supposed to be in chronological order. They are supposed to follow the order of payment. That since this was the first payment, it started maybe with the payment voucher 001. Then the other one, the next one will be 002, because it is the second that followed in terms of payment. So the traveling was classified under, or was categorized under the traveling category. Then on January 7th, we paid some postage charges or postage stamp of 84. The total amount was 84, and this one is supposed to be under the category of postage. The same 84,000. But remember that I told you that as you continue to spend, you also keep on adding up, and you can see that we had the cash float of 900 so far. From that we had the cash float of 900, and we have so far we have already spent 108. This is what came from the traveling, and then we had an additional 84 US dollars. So you need to take note as you keep on spending. So let's also take note that we have spent this 84, but it's supposed to go under the postage column in the analysis column. But when you add the 100 plus the 84, 108 plus the 84, it means that we have already spent 192 US dollars out of the 900 cash float. And this means that we have to deduct what you have so far spent from the cash flow that we have. And that's basically the main concept that I want you to understand in this part 2 of the Pet Cash Book video lecture, because we already saw how to make entries in part 1 of the same video lecture. Therefore, once you continue to spend, then you keep adding up, and this adding up that you are doing is not going to appear on this paper, you can add it from somewhere else. But this adding up is going to help you so that you don't overspend. Because you keep on adding, the moment you keep on adding, you avoid overspending, and then you'll be able to know when you're supposed to go for reimbursement, because no one will tell you that you are supposed to go for reimbursement at such and such point or at such and such date. So by adding up as you spend, you will be able to know when you should go for reimbursement. So you continue adding up until the next expenditure is higher than the balance that you have at hand, and then you can go for reimbursement. So, and we have so far seen that we have spent 192 out of our 900 US dollars. So we still have over 700 plus to spend. So we can now continue to spend as we look at our next transaction. So we keep on spending because we have seen we have more than 700. So you keep spending all this money. You keep entering the transaction that we have. We have the napkins that took 85. We had taxi fares that took 88, and taxi fare is following under, because you are paying transport costs, is falling under the category of traveling. Then the napkins falling under the cleaning. We also have petrol that is falling under the traveling, because that will be fuel. So you can see that, and as you keep spending until you reach on 17th, this 59. On 17th Feb, once you spend on, this is cleaning soap, and the amount was 59 US dollars. And we can see that we have only 91 as the balance. Because until you will keep spending up to the point you have reached that point, you will see that you only have 91 US dollars to spend. Now, of course, now when you have reached that point, you will see that the next transaction that happened on 21st. On 21st, we are seeing that we have a transaction that we can spend on as tax fare. Tax fare has an amount of 241 US dollars. But remember, we stopped on 17th, and on 17th, we only had 91 US dollars. That's the balance that we had on 17th Feb. But on 21st Feb, we saw that the amount we are supposed to spend was supposed to be 241 US dollars, but we only had 91 US dollars left. So you have seen that we only have 91 more to spend, but when you look at the next expenditure on Feb, this is the Feb expenditure, 21st Feb, where the expenditure that was on taxpayer was supposed to be 241. And obviously this 241, the next expenditure cannot be paid out of this 91 that we had on 17th Feb. So what do? We go for reimbursement, because the only amount that is available as of 17th Feb is 91 US dollars. But this one, 91 US dollars, the next transaction is supposed to be 241. So it is higher than what we have. So it means we have to go for reimbursement first before we can pay off this expense that happened on 21st. So this is where I want you to pay attention, because it's where we are going to go for reimbursement before we pay off the next expenditure for the period. That's where I need you to pay more attention, because that's where we need to understand how certain things are done. Now, what we do first, we first add up everything that we have so far spent money on. So we first add all the costs that we have so far spent money on. Remember, we are stuck on the 17th. We first add up the amount that we have so far spent on. Because I told you that you will be reimbursed the total amount that you have spent, and then you don't go for the whole amount that was supposed to be given to you, because the whole amount that was supposed to be given to us was supposed to be 900 US dollars. But what we go for reimbursement, we only go for the amount, how much we have so far spent. That's what we go for reimbursement. That's what is going to be reimbursed to us. That's the meaning of reimbursement. So the reimbursement is supposed to set us back to our original position. The original position was supposed to be 900. So because we have the balance, then the reimbursement is supposed to just top up the balance that we have already spent, so that we can get back to our original position of the 900 US dollars as our cash float. So if you look at the total that we have so far spent, you will see that we have spent 889 as of 17th, because we have only 91 US dollars remaining to sum up to a total of 900. This is our cash float. So the 91 that is left, when is added to the total payment, when you add up the total payment column, then you will see that the balance is what we're supposed to use to rule off the receipts column, because every time you are going to you are going to go for a reimbursement, then it will be a time for you to balance off both the debit side and then the credit columns before you continue. Because every time you are going to go for a reimbursement, first balance off that point. But you will see that the receipts side or the receipts column is higher than the total payment. Our total payment are summing up to $889 US dollars. But our receipt side has 900, which was our cash flow. So we are going to make the 900 to be the total for both the credit and then the debit sides, because the receipt side is higher than the total payments, meaning the 900 will be the total for both columns. And the difference, of course, this difference, you get the 900 minus this, the total that we have so far paid, we get the 91 US dollars. And that 91 US dollars will be the balance carried down, but it will appear on the side that has the smallest totals. And the side that has the smallest total was the total payment. All these payments were totaling to this. So we bring that balance as balance carried down and we write the 91. It will be a balance brought down for the next period. So it will be a balance, but brought down as 91 on the debit side of the cash book. So now what we are going to do, we are going to, after closing off this account, we are going to get the reimbursement. Reimbursement is going to happen on 17th. We have cash, we've received the cash, but how much are we receiving? We are receiving this 889. So that 889, when you add up the balance on the same date of 91, it will top up back to the 900 US dollars that we are supposed to be with as our cash float. Then once we have done that, we shall continue spending on the 21st. So what you need to know is that the difference, the other difference, that is the balance carried down, will be on the side that is smaller, which was the credit side. Then it will be, the balance brought down will be on the balance brought down will be on the same, on the opposite side of the balance carried down. But that amount will be still, the balance brought down will be still in the same period, because we are not closing off the account. No, we are just continuing to spend, only that we wanted to first go for reimbursement. So that's how to go about in the case that you have an expenditure that is more than the balance that you have. So before you go for a reimbursement, you first balance off accounts to see the balance so far you have, and you only go for the total amount that you have spent to date. Therefore, the main cashier will only add you the exact balance that you have spent, which is the 889, which is the amount that we have spent to date. And when you add up that with the balance that you still left with to date, you will be equaling to the 900, which is the cash float coming from the 889 plus the 91 US dollars that was recorded as the balance at that period. So the 889 will be recorded as cash that is coming from the cashier. So since this money is coming from the cashier, we are going to write that transaction in the folio as cash book 002. Remember, we are supposed to continue to keep the chronological order. If the cashier sent you the first amount, the cash float came from the cash book on the page 001. But when you receive a reimbursement, it will be a second reimbursement, and that money will come from the same cash book, but it will be on the page number 2 because we are keeping the order. It will be the second batch that the pet cashier has received from the main cashier. And the reason of this amount is just to restore you to your previous cash float. And once you are restored back to your cash float, then you can continue spending. And that's basically the idea that I wanted to bring out to you in this video. So once you have understood this, then every entry will be the same like the way we did in the previous video. So I want you to have this, then you go ahead and complete all the other remaining entries, and then finally balance off the accounts at the end of the quarter. You can first have a look at what we did, then you can be able to balance off. But the rest of the things, they are the same as long as you understand how to balance off these accounts and you don't overspend. So you have so far received the 889. You add up to the 91 US dollars. You go back to the 900. Then you can spend this 241. So once you spend the 241, the balance will be the 900 minus the 241. Then you continue spending until it's finished. Then you go for reimbursement, and that's how it's going to be done throughout. So that's all that I wanted to finalize with the pet cash book. Of course, from there we can Hello viewers, welcome back to our YouTube channel, CPA Charles Cafe Accounting Tutorials. And today we want to kickstart our discussion on bank reconciliation. We want to look at how can we be able to prepare a bank reconciliation statement. And today we are going to mainly focus on the theoretical aspects of our bank reconciliation statement. So we are going to look at the bank reconciliation, and this is going to be part 1 of our tutorials. So we are going to look at a series of different aspects that are going to be forming up our bank reconciliation statement. And that's what we are going to basically look at for now. So without wasting more time, allow me to take off my video so that we can dive into what we are going to cover for today. So welcome once again to our session of our accounting tutorials. And today we want to look at bank statement reconciliation. In other words, bank reconciliation statements. And you want to understand what bank reconciliation is all about. Now, bank reconciliation is all about the fact that a firm or any organization or business entity operates a current account. It comes into play because an organization operates a current account with their bankers, wherever they put their money, the company's money, whichever bank. Most of the times they operate current accounts with their bankers. And it is expected that at the end of every period, most especially at the end of every month, the bank column of the cash book should be agreeing with the bank statement in terms of the balances that are there. So we expect that the bank column, remember when we looked at the cash book, we said the cash book has a bank column and then a cash column. So we expect that the bank column of our cash book as a business is expected to be the same in terms of their balances with the bank statement balance. Because at the end of every month, we can pick our current account statement or ledger. We look at how it looks like, but we expect that the balance at that bank statement should be the same as the balance in our cash book, especially the bank column of our cash book. So that's what we expect. So we want to see that the balance, we want to see that we actually have the same balance that we have in the cash book as the same balance that is there in our bank account. And that's basically what a bank reconciliation is all about. A bank reconciliation is just looking at a situation where you can be able to make the cash book balance look exactly the same as the bank account balance at a given period of time. So that's basically what bank reconciliation is all about. However, it's not always the case. In other words, you are not going to find it in a sense that the balances with our cash book is the same as the balance as per the bank statement. Most of the times, the balances are not going to be agreeing. And it may happen that we, as the company, we think that we have, let's say, you can assume that maybe we have $20,000 US dollars in your bank account. And that's according to what you have paid, what you received, and you are certain that I must be having $20,000 on my bank account as the balance. Or if you look at your balance, your cash book, in the bank column, it says that the cash that you are supposed to have in the bank is supposed to be 20,000 US dollars. Now, most of the times, it's not going to be the same. Because for you may be expecting to have 20,000 US dollars in your bank account, but surprisingly, when you go for the bank statement for that particular period, you will find that that balance is either higher or lower. Because you can say, for me, I expect to have maybe this, but when you pick your bank statement, you find that maybe the balance is 12,000 US dollars, or it is maybe 25,000 US dollars. But for you, as per the cash book in the bank column of your cash book, we are seeing the balance should have been 20,000 US dollars. So you can have a higher figure or a lower figure. And that's most of the time what happens. So you find that your cash book balance in the in the bank column of the cash book is not the same as what you were seeing on your bank statement for a given period of time. Now, all that mismatch is the one that calls for bank reconciliation. We are trying to make sure that these balances agree. In other words, bank reconciliation comes into existence when we have such scenarios that for us we're expecting to have maybe $20,000, but when we pick our bank statement, maybe we are finding we have 25 or 12,000, depending on whichever amount that you have seen for a given period of time. So that mismatch is the one that is calling for the bank reconciliation, because bank reconciliation looks at reconciling the balances of the cash book as per the bank column of the cash book with the balance that comes out in the bank statement for a given period of time. So what we are going to look at here, we want to see what causes this mismatch. When in our books, it shows that maybe we have 20,000 in the bank column of the cash book, but then the bank statement amount is not actually tallying with what we have. So what causes that? And once we have realized that we have a difference or we have a different balance, then we shall need to prepare the bank reconciliation statement. So the bank reconciliation is the process, but what we prepare, we always prepare the bank reconciliation statement. We always prepare the bank reconciliation statement. So we prepare that bank reconciliation statement so that we can reconcile the cash book balance with that of the bank statement balances. And that's what this topic of bank reconciliation is all about. But now you have to remember that when you want to open an account with any given bank as a business, if you are coming as a business, there are very many different types of accounts that we can open. You can go to the bank and you say you want to open an account, opening an account for your business, an account for the business. And we said there are very many different types of accounts that you can open for your business. And among the different types, the types of accounts, someone can open, we can have a savings account for our business. We can have a current account. And finally, we can have a fixed deposit. So you need to remember that there are mainly 3 accounts that we can open for our business. Now, if you try to look at these fixed deposit accounts, if I may start with it, the fixed deposit account, usually we don't operate it with our business. Like, it's not always operated except when you want to do an investment, because a fixed deposit is where you put money in the bank to accumulate to a given amount. When you put it could be a fixed amount that you are saving maybe every month to accumulate to a future sum or it could be a varying amount. Anytime you come, you put money, but that money cannot be withdrawn before the other period you had agreed elapses. So that's why we are saying most of the times we don't operate this fixed deposit account unless you want to do an investment. Because for this account, you keep a certain amount with the bank and it is expected to mature at a fixed period of time, meaning it's supposed to mature in future. You can say I'm saving for 2 years, but after 2 years, I can withdraw the money. So you can save a fixed amount. Let's say I'm saving 1 million every month for 2 years. Or you can save any amount. They can set for a threshold that may be as long as you don't bring something that is below 500,000. You can bring 700, 1 million. The other time you bring 1.5. This time around you have managed, maybe you did get the money, you have just put the 500, which is the threshold. So the amount can keep on varying. But the motive is for you to withdraw that money after some period of time. So it is always good for investment, because in that fixed deposit account, you earn interest for the money that you have saved for a given period of time. So it is always good for investment, but as long as you want to just use it for business operations, it's not always open for the business. Because the moment you keep putting that money, it's going to be fixed, and you can only be able to access that money unless when that fixed period has expired or is done. Also, this savings, the savings account is an account where you make savings, and usually it doesn't operate with a checkbook. In other words, you put your money, then you can go and withdraw anytime you want. So it operates with savings. It doesn't operate with checkbooks. In other words, you can't sign a check. You can't have a checkbook for a savings account. Two, you can't, when you have to withdraw money, use the withdraw forms. There are those forms that you can sign and you withdraw money. If allowed, maybe you want to withdraw more than what you can withdraw using your ATM card or debit card or credit card, whichever. So, but now for this current account, this is where I want to put my emphasis. The current account is the one that is applicable to business, because it gives someone access to a checkbook, whereby you can have a checkbook. Others write it as a check like this, but for this checkbook, you'll have access to a checkbook. And because someone is going to ask himself or herself that why do I need a checkbook? A checkbook will allow you to save time. In other words, if you want to pay a supplier, there is no need for you to be moving at the bank. You line up in those different lines because you want to access money. What you do, you just sign a check. Then the other person will go and cash it out from the bank when you're not there. So the checkbook gives you that allowance, that not every time that you need a small amount, you have to go into the bank and withdraw the money. You can just sign a checkbook for someone to go and withdraw. So most businesses operate this current account because the current accounts avails you the ability to sign a check, and then you can give to the person to go and withdraw money from your account. And that makes the business transactions simple, because just imagine if you are supposed to be lining up for every transaction that you want to make. that today I want to pay this, today I want to pay this. So you find yourself every day you can pay like 10 people, and all those 10 people you have to go back and line up and withdraw cash, then you come and give them. So if you operate a current account, it's going to allow you have smoothen the process, because you can just sign up the check. You don't need to go and line up, and every time you want to withdraw some money for business from your business bank account, business current account. And that's why that's basically the main reason as to why businesses are operated on current account. Now, current account, if we are to focus on these current accounts make you own a checkbook, as I said, which makes business a very flexible, and you can have because it gives you that flexibility that not every time you need some money you have to go line up and be able to access some money, even for a small amount. So most of the times we operate current accounts. So that's what we are going to basically focus on for the whole of this lecture. So whatever we are going to be talking about as far as bank reconciliation is concerned, just know the account that we are mainly focusing on is a current account. Because we said that these current accounts, they are mainly operated for those businesses that operate current accounts, and they are the ones that prepares a bank reconciliation statement. Because the main reason as to why it is in that sense is that someone can go and bank money without you knowing. Two, I can say I've paid someone, but the person doesn't go to take the check to the bank to be cashed out. Otherwise, if we were to pick money ourselves, we pay our suppliers, we pick money, we pay everything, we wouldn't be having all these kind of mismatches, because we would be seeing what is happening on our account every time we go to maybe to make withdrawals. But since we just don't go there all the time, we find that the balances are going to be differing, and that's why you need to prepare a bank reconciliation statement to adjust those balances to make sure that they are the same, and it is very important. But before that, I want us to, before we look at the bank reconciliation statement, I want us to look at how the bank statement looks like as compared to the cash book, or as compared to how the cash book looks like. We can maybe just have just a small illustration of how a bank statement looks like, maybe for those who may not actually know. But even if you don't know, this is how the question is going to be. Most of the time it's going to be appearing in this kind of format. So let's look at the bank reconciliation. Just something small, talk about the bank reconciliation, the bank statement. The bank statement. But I want you also to remember that for the cash book, we have the 2-column cash book, we have the 3-column cash book, because I told the other single column cash book, it doesn't, most of the times it doesn't appear. But we always operate a 2-column cash book or a 3-column cash book, and the other petty cash for some organizations. And we said for the 2-column cash book is that type of cash book that has got 2 columns for both cash and the bank columns. And now the cash book that we are going to be talking about here is the bank column of the cash book. In other words, we don't need the cash column. In other, what we are focusing on, we are looking at only those transactions that went through the bank, only business bank transactions alone. They are the ones that we are looking at. So we extract that single column for the bank that shows the bank transactions. It's the one that we want. We want only the column that has the bank transactions alone. And what we do is that whatever we record in the bank column of the cash book is expected to be recorded in the bank statement. And that's what always happens in the bank statement. So the transactions that we have in that bank column of the cash book, they are going to be the same transactions, but the only difference is that for the bank statement, the way we record items in the bank statement, or the way items are recorded, it's a little bit different from the bank column of our cash book. It's a bit different because in the bank they will have, for example, now when we are receiving cash, or when you have cash into our bank account, when we are receiving cash, or when we are putting cash into our bank account, or when we deposit cash into our bank account. Because most of the times when we think that our bank account is increasing, then we, the business, we will record it on the debit side of the cash book. But at the same time, the bank is expected to credit our bank account or our bank statement. So we are debiting the bank when for us we are debiting the bank, the bank account in our cash book, the other guys are going to be crediting our account, because in the banker's books we are going to look like we are a liability. For example, the other bank is going to be keeping our money. It's like we have lent to the bank. That's why when you are working in the bank, you are the accountant of the bank. The money, people's money, are going to be liabilities that you have, because every time they increase their money in your bank account, you are going to be liable for their money. That's why every time for us we debit our cash book, but the bank is going to be crediting, because it's going to be a liability to them. But for us, we are debiting our account, and the other side they are going to be crediting our account. So just like the more you keep the money in the bank, the more you increase the liabilities for the bank, because the bank will be holding people's money. That's when you go and withdraw money from your bank account, for you are going to credit your cash book in the bank column, but the bank is going to be debiting your account. The reason as why they are going to be debiting is because you are reducing the liability. You had kept your money there, so the liability was high. The moment you keep on reducing, they debit your account because you are now reducing the liability that you had with them. So it is a little bit different the way we do the transactions in the cash book. When we debit, because for him, as per our cash book, we always think that the cash book is having a debit balance, so it has some money for us in the cash book. But when you look at the bank, your bank account, the more you have, the more credits you have, it means the more money that you have on your account. That is the implication. Because in the cash book, it's going to be a debit balance, but with that debit balance in the cash book, of course, it is a plus for the business. And the credit balance in the bank statement should be equivalent to the debit balance of the cash book. But what we've said, that when the bank is debiting your account, then it means that they are rather reducing your account. And that means that the equivalent of your debit in the bank account is the credit in the cash book of the business. When we withdraw money or when we pay people, we credit our cash book. And crediting our cash book, if we have paid them by bank, automatically our bank account is going to be reducing the amount. So the implication is that the more you credit your cash book, we expect the same proportion should be reduced from your account. The more you credit your cash book, then the alternative should be the more the bank should debit your account. That is the implication. And the more you receive money, the more you receive money, meaning the more you debit your cash book in the business, then it means the same proportion should be at the bank when they are crediting your account, to show that reflection of the money that is in that account. I hope you are getting this, because we expect that the balances of the debit balances should also be the same as the credit balances. Like what you have recorded as the money you have received in the business should be the same money that is there in the bank statement. But your bank statement is going to be recording it in the credit column. But for you as a business, in your cash book, you are going to be recording it as a debit entry. So that's what we are basically talking about. So let's look at the format. Now, for the format, of course, we always start with the dates. Then we have particulars or details. Then we have the debit side. Of course, this one has a current sign, but I will put in later. Then we have also the credit, the debits and the credits. Then we have also a column for balance, and this is how the bank statement will always look like. So we can have things like maybe Jan 1st. We can have maybe the balance for the previous period. This will be the balance brought down. It's not going to be in any of these, it's going to be this side of the balances. Let's say we have 1,000 US dollars. Let's say all these are in US dollars, the currency. So once you start the transaction, maybe on 10th, we've gotten some customers deposited some money. Let's say maybe Stuart. when the customer deposits the money, your cash book is going to record a debit balance. But for us in our bank statement, it will come as a credit. So if Stuart paid us $2,000, meaning the balance is going to keep on adjusting itself. We are going to add this plus this, it is going to give us 3,000. If we withdraw, now, if let's say we look at maybe on 15th and we withdraw, there is a cash withdraw. Cash withdraw, it's going to be on the debit side. Let's say we have withdrawn maybe 500. If we withdraw 500, the balance has to reduce. You will get the 3,000 minus the 500, it will give you 2,500. Now, the expectation is that this balance, sorry, this is 2,500. So the expectation is that this balance here, the 2,500 that is there as your balance as per 15th, should be the same balance in the cash book as per that same date of 15th. In other words, if your bank statement looks like this, the cash book will be looking like this. Let's have also we are just going to draw only a single column for we are only picking out the column for bank. So this is our cash book. But remember, the cash book, we are only taking out that bank column. So on Jan 1st, remember this one was we had some money, 1,000, which is the balance brought down. It's going to be on the debit side, balance brought down of 1,000. Then Stuart deposited 2,000. Once Stuart deposits 2,000 on 10th, it's also going to be debited because we are increasing our bank account. So this one is going to be Stuart, maybe is our customer, paid some 2,000 US dollars. Then we made a withdrawal. We made a withdrawal on Jan 15th. We made a withdrawal cash. We converted it, cash withdrawal of 500. Remember here, I always told you to put the currency sign, and we are working in dollars. So we close off the account. This side is bigger than, because this is 3,000, even this side must be 3,000. So as per 15th, because we are looking at 15th, that's the end of the period. This is balance carried down of 2,500. Now you are seeing that on Jan 16th, because this was 15th, Jan 16th, the balance brought down. Balance brought down is 2,500. This is what I'm meaning, that this amount is the same amount that we have in our bank here. That is the implication of what we've been talking about. But most of the times, this balance is not always the same as this balance that we have here. And if that's the case, then we do what we call the bank reconciliation statement. So that's what causes us to do a bank reconciliation. So for example, if at the beginning of the period we had maybe 2,000, let's say 20,000 US dollars in the bank as our balance in the cash book, then we should also have that same 20,000 US dollars as the amount that we shall have in the bank column. But we shall need we are going to understand how we can adjust this. I hope now you can see that the balance that we have as per the cash book of 2,500 US dollars is the same as the balance as per the banker statement. And this is basically what we are trying to mean, that at every point in time, the balances in the cash book should be the same as the balance in the bank statement. However, we are trying to say that unfortunately, this is not always the case, because there are a lot of reasons that will cause a difference in the balances of both the cash book and the banker statement. And those factors will make you have a different balance in the bank statement, and also a different balance in the bank statement are the ones that we want to know, or they are the ones that are calling us to do what we call the bank reconciliation statement. And at the end of the day, or at the end of the period, when you get your bank statement, you find that you see that the balances that you have in your cash book and the balances that you are seeing in the in the bank statement, they are not tallying. And once that happens, then you'll have to prepare a bank reconciliation statement to reconcile that difference. Therefore, we want to understand the bank reconciliation statement and also learn about the factors that may cause the difference between the bank statement balance and the cash book balances of the business. And that's mainly what we are focusing on in this video. So let's try to do the bank reconciliation. We are more focusing on the reconciliation part of it. We have seen how the bank statement looks like. We have seen how the cash book, the bank column of the cash book looks like, and we've tried to be able to elaborate some of those things, but let's focus mainly on the fact that we have seen that there are some mismatches within the balances of both the cash book and the bank statement. Now, having understood that we have those differences most of the times, I want us to look at the bank reconciliation statement and we try to understand what a bank reconciliation statement is all about. So mainly, we are going to look at the bank reconciliation statement. Bank reconciliation statement. How do we come to that? So, a bank reconciliation statement is a statement, we can write something, is a statement prepared by the current account holder. Prepared by the current account holder in order to bring their balances, balance of the cash book When you're talking about the cash book, we are meaning the bank column of the cash book. We are trying to bring the balance, balance of the cash book into agreement with the balance of the bank statement. And that's what we basically mean by bank reconciliation statement. It's just a statement that is helping us to match the cash book balances and the bank statement balances. However, you have to remember that I said it's prepared by the current account holder. In other words, we say that the businesses operate current accounts, and it's the current account holders that prepare the bank reconciliation statement. So you need to understand that. So it is prepared by the current account holder in order to bring balances of the cash book into agreement with the bank statement balances. And that's what we call the bank reconciliation. In other words, that's the process of reconciling the bank statement. However, as I said, that there are a lot of factors or reasons that cause the differences of the cash book and the difference of the bank statement. The bank statement balances. There are a lot of factors or reasons that cause those differences, why there is a difference between those two balances, the cash book balance and then the bank statement balances. And I want us to first try and look at some of these factors. These factors, all these causes, they are the ones that we are going to base on to do all the computations. So as long as you understand these factors, you are not going to find any problem whatsoever in doing any number to do with bank reconciliation. So let's look at the factors. Factors that cause a difference, in the balances of the cash book and the balances of the bank statement. So this is basically what we want us to understand. And as I said, there are a lot of factors that will cause a difference, and we are going to try and mention a few that will help us to understand this concept very well. And the rest of the factors or the rest of the causes, we shall look at them as we move on, especially when you are doing the practical simulations. So we shall talk about them as and when we meet them in the bank reconciliation, in numbers requiring us to do a bank reconciliation. But I'm going to make sure that I talk about the main items that will, or the main factors that will cause a difference, because there are very many factors, as we shall see. But just know these factors, they are going to help us a lot, especially when we are solving the numbers. So you better understand them. Otherwise, if you don't understand them, there is no way you are going to apply them. Because whatever we talk about, we are going to look at it in the computation. There is no factor that we are going to look at that we shall not find in the computation numbers. So this is one of the numbers that is very straightforward. As long as you understand the concept, the rest is very easy. Now, the first one that I will mention as a factor that will cause a difference is called unpresented checks. Unpresented checks. Unpresented checks. So, unpresented checks, these are checks. These are checks that have been drawn by the business, and issued to the suppliers, for payments. On whatever they are supplied, on whatever they have supplied to the business. They have supplied to the business. But these suppliers have not yet presented the checks. They have not yet presented the checks to the bank, to the bank for payments. So those are the unpresented checks. You as the business, you have paid someone, maybe they have supplied cleaning services, they have brought materials, you wrote to them a check. To draw a check is just to write a check. You wrote a check to them and you handed the check to them for them to go and withdraw the money. But for them, they have taken some time, they have delayed to take the checks to the bank so that they can withdraw money from there. What is going to happen is that for us in our business, we have recorded that we have already paid those suppliers. But in actual sense, the money is still on our account because the suppliers haven't presented the checks to the bank for payment. Remember the reason as why we are operating current accounts. We don't want to go and withdraw money by ourselves and we pay suppliers. No, we just write to them checks so that they can go and claim their money. But you know, these checks matures at some point. If I give you a check today and tomorrow I pick a bank statement, when maybe the check is supposed to mature in 3 days, automatically, even if you had presented it in the bank, the money will be still on my account. So there are some small reasons, but the general picture is that these are checks that have been submitted, that have been given out by the business to the suppliers for payment, but the suppliers, they have delayed to present them to the bank for payment. So you as a business, you owe a supplier, or a supplier is demanding you some money, but later you write a check to them so that they can take it to the bank and claim the money or withdraw the money using that check. And it happens that the business picks the bank statement maybe at the end of every month. If let's say, for example, I give you a check on, let's say, today is 29th. If I give you a check today is 29th, the month is ending, is about to end. So if I give you a check today, and by maybe you take some 2 to 3 days and you have not presented the check, to the bank for payment. By the time I pick the bank statement, that money will not be adjusted. But remember, in my cash book, I had already recorded that as a payment because I gave out the check. So you find that me, I can pick the bank statement. By the time I pick the bank statement, you haven't, the supplier delays to pick the money from the account. So once I pick the bank statement, let's say for this month, this is October, supposed to end 31st. If I give you the check today, 2 days from now, the month will be ending. So if you take it on the 3rd day, you'll find that it's going to actually to show the other amount not deducted yet. In my cash book, it says I had already paid off. So that's basically what is going to happen. So my cash book will be reading a different figure, even the bank will be reading a higher amount because the other customers, the other suppliers haven't picked the money that I had paid to them. So that's one of the ways that can cause those balances to be different. Now, let's now look at the other as the uncredited checks. Uncredited checks. Now, for uncredited checks, these are checks that have been received, by the business from the customers or the debtors, the people who supplied goods on credit, by the customers or the debtors, and have been paid into the bank. They have been paid into the bank, or they have deposited the checks into the bank, but the bank hasn't yet credited, has delayed to credit, the money, into our business account. So as I told you, you go and the customers, they have paid, and they have taken them, they have presented the checks to the bank. The customers have paid by check. When they brought the check to us, we've taken the check to the bank, but the bank has delayed to credit our account. Remember, when we are putting money the other side, for us, when we receive those checks from the customers, we are going to debit our cash book that we have received the money, and we take those checks to the bank so that the bank can pay us. Most of the times it happens, some of these banks, due to different targets and they may delay some transactions without anything that maybe something wrong, no, but they just delay depending on how maybe they want to meet their targets. You take your check and someone sits with it. He says, I'm going to bank it, I'm going to credit, because they are looking to meet their targets. So it may happen like this is the last day. If a customer pays, today is 29th, if a customer pays me today and I take the check tomorrow, I will expect that on 30th, the money should have been credited to my account. But by the time it clocks 31st, I pick the bank statement and I will be seeing that those guys, they delayed to credit that money. Because delaying to credit that money, it means it will not reflect on the bank statement. So for us, we have recorded it in our cash book that we have received money, and we expect that same amount to have been credited to our bank account so that we can increase the amount. Remember, these uncredited checks, if they were credited, then they would have increased our amount in the bank account. Because we have already increased our cash book. In a cash book, when you receive the check, of course you debit your cash or bank. Of course it is a check. This day you are now going to debit your bank, then you credit the customer. And once you pick the check and you take it to the bank, we expect the bank to credit your account. So that is the implication. And crediting your account means they should have increased your account by that amount that was on the check. So by that, if let's say you pick the bank statement and you find this is not there, then that will also cause a difference. And as I said, the bank can receive the check and then it delays to credit the money on your account. And when the month ends, you pick the bank statement and you find that you realize that the check that you had deposited into the bank were not credited by the bank into your account at the time they receive the money. So meaning that the cash book balance will always be higher than the balance on your bank statement because of those uncredited checks. And that's basically what the uncredited checks are all about. Specifically, checks that have been deposited by the business into the bank, but they have not yet been credited to the business banker account by the bank or by their financials. And I hope you can get the difference between the first one. The first one we are paying our creditors or suppliers, but they didn't pick the money. They didn't take the checks to the bank. But here, the customers paid us, we took there, but it is the bank which delayed to credit our account. So those are two. Number 3, the next factor that caused the difference is we can have standing order payment. Standing order payments or standing orders. Standing order payments. Now, a standing order is a payment, is a kind of a payment, and normally it's a written instruction. It is actually a written instruction from the business to the bank, and the business will instruct the bank to pay an expense on behalf of the business. In other words, standing order is just a written instruction. You can just call it a written instruction. A written instruction from the business to the bank to pay an expense on behalf of the business. So you instruct your bank that you'll be paying for me maybe these monthly deductions. Every month you'll be deducting some amount to a given service provider. So you instruct, you write, so it's an instruction or it's a commitment that you write to commit that they should be deducting. You allow your bank to be deducting money to pay the service provider on your behalf. So you instruct your bank as maybe to pay things like electricity. You can instruct them to pay your electricity bills. So some of the standing order payment could be electricity bills, that every time Umeme sends a bill, it goes direct to the bank and the bank makes payment. So when you write a standing order, sometimes the money will be deducted without your knowledge, because the other supplier or the other third party that you are paying will just present the bill to the bank. And once the bank sees the commitment that you made or the standing order that you made, they will be paying that same amount that was identified in the standing order. They will only notify you maybe when the other person brings something more than what you had agreed on. That's when they can decline, or they can call you to first confirm. They may be things like rent. Then you can have things to do with the monthly subscriptions. Let's say DSTV, you are paying DSTV subscriptions. So instead of you be lining up and paying some of these expenses as a business, because these expenses, they are relating to the business, what you can do, you just instruct, write a standing order, they be deducting the money and they submit to the other. It may be in terms of QuickBooks. With accountants, we can be using QuickBooks, and you know QuickBooks, they are going to be charging you money. QuickBooks services, you could be using payroll, you could be using anything. So that is going to be deducted on a regular interval, depending on the amount specified and the dates you have put in that standing order. And once you write any note to authorize the bank, and you ask them to be paying some expenses on your behalf, then we call that the standing order payment. So it is just a written acknowledgement to the bank, instructing the bank to pay an expense on behalf of the firm. But now, sometimes when you do that, what is going to happen is that as the business, you may not actually know when the money has been released to the other people, because these guys, they will just be submitting the invoices to the bank for payment. So they will be sending those utility bills to the bank, and the bank will be deducting your money from your account without your knowledge. And the only time for you to get to know is when you go for a bank statement. You will find that, hey, of course they paid these guys, because most of the times they may deduct depending on the dates may be varying, but the amount may be fixed, but the dates may be varying. That every time they send, they make payment. So because you don't actually know, then at the end of the period, you will see that money has been deducted from your account, and you find that the money on your balance or on your bank statement will be different from the balances that you'll be having in your cash book. Because if you had known that they have made some payment, you would have adjusted your cash book. But since you didn't know, you only find out when you have gotten the bank statement. So that causes a difference in the balance that we have in the cash book and that we have in the bank statement. So the bank statement figure, as per the standing order, will always be lower because they will be chopping your money. For you, be having a higher value in the cash book, thinking you haven't paid some, but yet the bank has already made some payment. So when the bank makes payment on your behalf, then those are going to be reducing your bank balance. Your bank balance will always be lower and the cash book balance will always be higher because you haven't gotten this adjustment that they made payment of. So that's it. Now, the next point that I want us to look at is what we call the credit transfer. Credit transfer. Credit transfer is just simply means that someone putting money into your bank account without your knowledge. Sometimes it is called direct credit. Like for the customer, if let's say you supplied some customer goods on credit, and instead of these guys writing to you a check that they show that they are paying you, they just go and bank the money. They don't even send the proof of payment. So they have banked the money is there on your account. So for you to only realize when you have gotten back to pick the bank statement, that's when you will see that so and so made a payment, but in the cash book it wasn't adjusted. So meaning, if there are these credit transfers or debit direct credits, it means your bank statement figure will always be higher compared to that one of the cash book, because customers deposited money into your bank account, or you earned some interest, you earned some money. Maybe it was a bank interest that you received. You earned it and the bank didn't inform you. The customer made a payment and never sent the proof of payment. So you only realize that when you have gone to the bank to actually check out to see the money that is available. By the time you pick the bank statement, you'll find that the money that is there is higher than what you expected to be there, or is higher than what it should have been as per your cash book. And the reason why it is happening is because of these credit transfers that were made by your customers without your knowledge. So the customer, instead of them writing checks to you that they tell you that we are making payments, they just deposit the money directly to your bank accounts. And you may not be aware, especially when these customers, they don't bring the proof of payment to you. But by the time you go to pick the bank statement, you can realize that there was a direct transfer. And once you realize it, of course, you record it in your cash book so that you received some money. And that's the whole process that you will go through, as we shall see, of how we can reconcile such differences. So the direct transfer or the direct credit from your customers or your debtors, they will increase your balance as per the bank statement, causing it to differ from the cash book balances. Otherwise, if you knew, you would have maybe adjusted your cash book so that you can reflect those values. Then the other that will come in that same way, or that behaves in that same way, is maybe dividend paid. If let's say your business invested in another business, they bought some shares outside that business and they are earning dividends as shareholders, what will happen is that the shareholders may not give you notice when they are making the payment. As long as the dividend has been declared, they will pay anytime. So they will pay to your account without you knowing. By the time you pick the bank statement, that's when you realize that, of course, I received money from the other company that I made investments in. The other is also interest income, interest received. You know, the bank can charge you interest as an expense for the loan, but at the same time, they can pay you interest. Maybe you have been saving with them and you're earning interest. The interest will just be credited to your account and they will not notify you. So you find yourself, by the time you pick their bank statement, the balances are higher. So these dividend paid, interest received, they behave in the same way like the direct transfer, the direct credits. So if you had, maybe you had invested in bonds, you had invested maybe in preference shares, you know, for shares, they give you dividends. But if you have invested in, you have given a loan to someone, they will pay you interest on your, they will pay you interest. The cash flow will be interest. But for shares, the cash flow will always be dividend. Now, the next factor that I want to talk about is called the bank charge. Bank charges. Now, once you are operating a current account, then automatically you are bound to suffer some charges. And these charges are made by the bank for rendering their services. And sometimes it may come because of the work that they have done on a single transaction. And they may come in terms of things like excise duties. They may be like excise duties. They may be things to do with monthly management costs. I don't know, maybe, but most of the times they are monthly management fees. So any charge that may come on your account as a business, the bank may also charge you things like account opening costs, opening the account, opening account costs. And these costs may be known to you as the business only when you have gotten the bank statement, because these costs are going to be charged directly from your account. The bank will pick money from your account for those services. There are also other charges like stamp duty and others. They may be deducted based on a given threshold. So any other account that may come on your account, those charges are going to be deducted directly from your bank account and you will not know. The only way you will know is when you have got the bank statement from the bank, maybe at the end of the month. So all these, since they are going to be deducted from your account, they are going to reduce your balance as per the bank statement. For you to be having a higher figure on your cash book, but because of this, these costs were deducted without your knowledge. Or in other words, they didn't inform you, but they were deducted. Then you'll find that the balance will be a little bit less than what you have in your cash book. So the next factor that we can talk about is we may have things like the wrong credits and wrong debits. This is also something that is very common. Wrong credits and wrong debits. So wrong credits and wrong debits, these are some of the things that we may have. Now, wrong debits is when the bank debits your account in error. In other words, the money was not supposed to be debited to your account. When the bank debits your account, it means they have charged your account when they were not supposed to charge it. Because debiting your account is like we are reducing your account. So your account may be charged wrongly. That's what we are meaning. For example, maybe they were supposed to charge a customer, but someone bears a similar name, and instead of charging the other person, they charge you. And for you can only realize that by getting the bank statement. By the time you get the bank statement, you realize that you've been charged for the things that you don't know. Because remember, the people who are actually working in those banks, they are also human beings. They make errors, though errors are assumed to be minimal, but they may happen. So what is going to happen is that your account may be charged wrongly, and when they charge it, or when it's debited, it's going to be reducing your balance as per the bank statement. So when you pick the bank statement, you can only find out that they had charged you the amount that you are not supposed to be deducted. So that amount will make the bank statement balance to be different from the cash book balance. So that's what we call a wrong charge on your account. Then the opposite is the wrong credit. The wrong credit is the opposite of a wrong debit. The wrong credit is when your account is credited in errors. The money was not supposed to be yours, but it has been credited on your account in error. Because what you have to understand is that this wrong debit, it reduces your bank balance, but a wrong credit increases your bank balance. As long as you know what is the impact of that factor to either the account of the bank or the cash book of the business. So your account can also be credited in errors. So when that happens, you'll find that your bank statement balance will be overstated, because you'll have a higher value as compared to your cash book balances. And those are the things that we need to correct. The other that I want us to look at, the other factor maybe we can talk about, are errors. Because errors can be committed anywhere. An error can be committed by the accountant in the cash book. Errors can also be committed by the bank in the banking details. So errors, they are just errors. Because it could be an error of commission, omission, commission, depending on anything. Someone can just skip the transaction. You didn't see and you didn't put it there. It will cause a mismatch. It could be a wrong entry. You could even overstate. Instead of writing 12 million, you write 1.2. You could even understate. And these can actually happen either in the cash book or in the bank statement. That's why here I'm not going to over-explain it more. But you have to just know the impact. What is the impact of that error on whatever side that has been committed? Because it can be committed in the cash book or in the bank statement. And once the error or once there is a mistake, then you have to know the balances that are going to be changing. Then you can adjust those documents accordingly. So once we are preparing the bank reconciliation statement, we do correct those errors, because we will prepare what we call the adjusted cash book or a revised cash book to reflect the changes that are to be made in the cash book. And then we will also prepare the bank reconciliation statement to reflect the changes that is to be made in the bank statement. So the two balances will now agree. And that's basically what we are going to do. But one key thing I want you to note is that when the errors are committed by the accountant in the cash book, if these errors, they are in the cash book, they are committed by the accountant of the business, they are now in the cash book, then you have to take note that because error can happen on the debit side or on the credit side of the cash book. But what you have to know is that when an error has been committed in the cash book, it must always be collected in the cash book. In other words, when there is an error in the cash book, it is supposed to be collected in the adjusted cash book. But when an error has been committed by the bank, then that error is supposed to be collected from the bank statement. That is very important. An error that has been made in the cash book should always be corrected in the adjusted cash book. In other words, errors of the cash book are corrected in the cash book. Errors of the bank statement are corrected in the bank statement. And the way we correct in the bank statement is by using the bank reconciliation statement. The way we correct errors of the cash book is by using the adjusted cash book. And I hope we are getting those two things, because they are very critical. I told you these theories, they are the ones that are going to build on, we are going to use to build on in our computations. So when you are solving a question, you can see that we may find a lot of errors running through. So don't be confused as to where they should be corrected from, because the kind of guidance I'm giving you right now is that you look at the error to see whether the error has been committed in the bank or it has been committed by the accountant of the business in the cash book. And once it is committed by the accountant in the business, then it should be corrected in the adjusted cash book. And if it's committed, if the error is committed in the bank, then it should be collected in the bank reconciliation statement. But we shall look at how it's going to be collected in the next video, of course, where we are going to try to understand and we'll get these formats, and we'll take also a practical question as well, so that we can be able to improve our understandings. But for now, you can take those as our factors. But as I said, there are many. But for now, those are the main ones that you can take as the causes for the imbalances in both the cash book balances and then the bank statement balances. And as I said, there are other factors. We've not talked about things to do with the dishonored checks, but we shall understand them. We haven't talked about those dishonored checks and other things that may come up as we look at the numbers. So what I want to do now, I want to stop the video right here so that in the next video we can look at our bank reconciliation part 2, where we are going to look at the format of the adjusted cash book, the format of the bank reconciliation statement, and also decide on which approach that we are going to use to be able to do our reconciliation very well. So thank you for watching. Let's meet in the next video as we are talking about the same bank reconciliation part 2. Hello viewers, welcome back to our YouTube channel, CPA Charles Cafe Accounting Tutorials. And today we want to continue with our series on bank reconciliation. We looked at our number 1, that was basically looking at the factors that are causing the difference between the bank statement and the cash book balances. And what we want to look at today is we want to look at the structures or the formats or the layout of the adjusted cash book that is going to help us solve all the mismatches that we had in our cash book. We'll be able to adjust errors and also look at the format or the layout of the bank reconciliation statement. Then we shall also decide which preferred way are we going to be able to prepare this bank reconciliation statement. So that's what we are going to look at in this video. So allow me to take off my video so that we can be able to have a full screen view of what we are going to discuss today. All right, this is bank reconciliation part 2. Bank reconciliation. This is part 2. And the key things that I want us to look at, as I said, we will need to look at the different formats of the bank reconciliation. We'll look at the format of the adjusted cash book, and we'll also look at some other factors that we think that may be important and we haven't spoke about them. Then also deciding on which format are we going to be taking for solving bank reconciliation questions. So let's now kick off with, let's start with the adjusted cash book. So adjusted cash book. So first of all, we have to look at the format of this adjusted cash book, and then we shall also look at the one for bank reconciliation statement. And then maybe if time allows, we will take a practical question to see how we can do that will help us to prepare the adjusted cash book or the updated. If they don't call it the adjusted cash book, you can call it the updated cash book. You're just updating the previous one, because in the question they will give you both the bank statement and then the cash book of the business. Then you'll be able to maneuver through, see what is required, and see what to do. So this adjusted cash book is going to help us to adjust those factors that caused the difference between the two balances, which were from the side of the cash book. So the adjusted cash book is mainly looking at those factors that caused a mismatch in the balances, in the two balances of the cash book and the bank statement. But when you're looking at the adjusted cash book, the main factors that we are looking at, those are the ones that are arising from the cash book itself. and those are the ones that that caused the bank statement to be, or that caused the bank to be adjusted in the balance in the bank reconciliation statement. But before we look at that, let's just first look at the format of the adjusted cash book. So the format of the adjusted cash book, format of the adjusted cash book. So you'll always begin with the balance. You always begin with the balance as per the cash book, the balance that was given to you in the question, the cash book balance. So the question will always tell you that the cash book has shown the balance maybe of $10,000, $20,000, whichever balance they have told you. And then they will also tell you the bank statement also shows the balance of, let's say, $7,000 US. Or they may not tell you that, they may just give you the figures, because when they will give you those balances, we saw the column for the balances, you can be able to pick the balance from that. Therefore, when you are starting your adjusted cash book, you always begin with the balance of the cash book. So if it is a debit balance, then you put it on the debit side of the cash book, of the adjusted cash book. And if it is a credit balance, then you also put it on the credit side of the adjusted cash book. So in the format that we are going to prepare, I want us to assume that a balance was on the debit side of the cash book. So we are going to put it in the debit side. So how it looks, the cash book, it's the same way we looked at how the cash book was looking like. Just a T account. Remember, we are only picking out the bank column. This is our adjusted. So we shall have the dollar sign here, or the currency, whichever currency, can be in shillings, can be in shillings, whichever currency that you are doing that in. So we will say that we are going to assume that the balance is it. So I'm going to assume it is balance brought down. We are going to put it there. Just going to be using X to mean those values. Just represent them by X's. So that's our balance brought down. And the next thing to do is to go through the factors or the reasons that caused a difference, and you find out which ones were from the cash book. So what we are trying to do is that we are trying to adjust the cash book to get the correct balance for the cash book. Therefore, the things that were supposed to be debited to the cash book that were not debited, then you'll come and debit them here. And also the factors that were supposed to be credited to the cash book and they were not credited to the cash book, then you can come and credit them here. So if there was an error in the cash book originally, then you can also correct that same error, because we said errors that are committed in the cash book will always be adjusted from the adjusted cash book. So if there are errors that are committed originally in the cash book, then you correct them here. So for now, there are some common items that usually appear in some of the questions. And I want to show you how we can treat them. For example, if you look at on the debit side, because this is the debit side of the cash book, this is the credit side. So if you look at the debit side, most common things that you will see, we have things like credit transfers or direct deposits, credit transfers. Say the other name is direct deposits or direct debits. And I explained credit transfers as when someone makes a direct deposit into your bank account without your knowledge. And when that happens, the bank will credit your account, and when the bank credits your account, then the corresponding entry is that you must debit your cash book. And if previously you didn't do that, then you can now do it by correcting that issue. That's why we are bringing here that figure. We said you can call it direct deposit or credit transfer. We are looking on the debit side alone. The other, we have things to do with interest that was credited to your account, interest income received, income credited, interest credited to your account by the bank. In other words, any income credited to your account by the bank when you are not aware. So whatever the bank has done that you didn't do, then it's what we are trying that's what we are trying to bring out so that it appears in the adjusted cash book. And that's what usually what we do. So we bring in the interest received. We can also bring in things like the dividend received. Dividend received. The dividend received. So the dividend received, the interest received, those are the ones that we are. So what we did, we look at what we did, but the bank did not do. So when you are in the adjusted cash book, you look at the things the bank did, and for you as a business, you didn't do. But when you go to the bank reconciliation, the things you did as a business, but the bank never had those transactions, they are the ones we do adjust in the bank reconciliation statement. So I want us to get the difference from the start, that the things the bank did that we had no idea about, they are the ones that we are bringing in our adjusted cash book. And the things that we did as a business and the bank never had any idea of what we did is the one that we take to the bank reconciliation statement. Therefore, the things I did as a business in my cash book that did not reflect in the bank statement will be adjusted or corrected in the bank reconciliation statement. And the things or the transactions that the bank has recorded, which we, the business, was not aware of and we didn't do, then we are now showing them in our cash book. So usually you see that the things that are here in the adjusted cash book are the things that are in the bank, which are not done yet by the business. So those things that the bank did, for example, if let's say if the bank credits our account with an interest, then we have to adjust our cash book by debiting that same interest. I hope we can now pick this side. So let's now go to the credit side. Let's go to this side of the transaction. So the credit side of the adjusted cash book, we also look at the common things that are always there. So when I talked about the standing order payment and I expanded a standing order in my previous video, because we looked at this kind of things that the bank can pay on behalf of the business through that standing order, whereby the bank instructs the business instructs the bank to make some payments on its behalf. So what happens, the standing order, what happens is that the bank has paid an expense on behalf of the company, meaning that our bank account has been debited, and because of that we will come and credit our cash book. So we bring things to do with standing order payment. Standing order payment, such an amount. Standing order payment. And we also talked about bank charges, and these are things that are already done in the bank, and the bank has already charged our account, which means that they have already debited your account, and because of that you will have to credit your cash book. And because you didn't do that initially, that's why we are doing it now. So we also bring in the bank charge. Bank charge, management fees, and others. But we need to take note that there can also be interest charge. Among these expenses, there can be an interest charge as well. And the interest can be on the credit to your account as an income received, as we saw it from here. But it can also be a charge to your account. If at all maybe you had taken a bank overdraft, you had borrowed some money. Maybe you had taken a bank overdraft, but it's now an example of it's like an example of a bank charge, whereby it will be deducted separately. So I want you to appreciate the fact that interest expense can also be charged as well as received. So once you have interest charges, then we include it there. Interest charges. It can also be received. When you are receiving interest, maybe you have made some fixed deposit, or it's a savings account and they are paying you something. Now, also if you see a dishonored check in the question, for example, if you have received a check from your customer in settlement of their debt, let's say you had sold to them on credit, the customers, meaning you have your debtors. So you find that you had already debited the check as a receipt in your cash book, because previously when you receive a check and you take it to the bank and the bank dishonor it, or they refuse to pay, there are reasons that we may not look at for now. There are reasons for dishonoring a check. It could be maybe the person who signed never signed well, the signatures they are not matching. 2, the amount could be insufficient. The person may be paying you 2 million, but on the account there is only 1 million. It can be dishonored for that reason. Even when you have not put in the right, you have left some spaces, the signatures, like you wrote differently, you signed in a different, where you're supposed to put a name is where you put the signature, and where you're supposed to put a signature you put the name. So those are some of the small things that can lead for a check to be dishonored. But what I want you to understand, the main point is that a dishonored check happens in the cash book for you when you received it from the customer. You debited your account because you thought the customer is paying you. You thought money is coming in the business, so you debited your cash book. So once you debited your cash book, but you took the check to the bank and the bank refused to pay, they dishonored that check. So it means since you had already debited it, you must credit it to remove it from the transaction. Because if you leave it there, it's going to increase the balance. It is assumed to have increased your cash book balances, yet you didn't actually get that money in your bank statement. So what you do, you credit it to remove it. So dishonored check. So the reason why the check has been dishonored, meaning when the check has been dishonored, it means the bank has not credited your account. And once the bank has not credited your account, but you had already debited your cash book initially, then what you do, you have to write it off to remove it. So what happens is that because you had debited initially, you had debited your cash book initially, then, and the bank did not, the bank did nothing, it didn't pay, didn't credit your account. Then now what you do, and once you have known that the check has been reversed, then you can come and also reverse the entry for that dishonored check. So that's basically what we are doing. If it happens in the other way around, whereby you paid the supplier, but the check was also dishonored, you also do the same. Because me as a business, I can also write a check to the supplier when the money is not there, and it will be dishonored. So you do the same. Now it will be going this side, the debit side, because previously I had credited my cash book. Now we also have things like the direct transfer. No, these are not direct transfer. They are debit transfers, or what we call the direct debits. These direct debits, those are scenarios where the bank charges you money without knowing. So the debit transfer doesn't usually appear in the cash book. It is also similar to a standing order payment. So there could be something to do with those direct debits. But what you have to know is that the bank can't just deduct money like unknowingly without your knowledge. Of course, it may appear that it may be the opposite of credit transfer, whereby this time around the bank will be the one to deduct. For the credit transfer, it is the customer paying. But for this, it will be the bank deducting. It is very possible, like for these businesses that run Google ads, Facebook ads, as long as you have those ads, you find that on your credit card, money was deducted using your either credit card or debit card. because when you are paying for these Google ads through those social media advertisement, through those ads, what they do, money is deducted directly. It's as if they just deduct it from your cash, as long as you attach your credit card or ATM card on, because there is no way you're going to use Google ads minus attaching your ATM card numbers to those Google websites or Facebook ads. So that money can be deducted directly. When the ad ends, money will be deducted direct. They may not inform you, money will just be chopped from that account. If let's say you are buying these things to do with the subscriptions, it may be there automatic that the money will be deducted. There are these subscriptions, annual renewal. You find that when the time reaches, money is picked from your account, especially for Google ads, Facebook ads, social media advertisement. That's how they deduct the money. You put here your ATM card, you connect it to the website, the money will be chopped as long as it means a certain threshold or the advertisement is complete. So there could be those direct debits whereby they can pick the money. It's a little bit different from standing order, because standing order, it's the business authorizing. It comes into play only that by the time the other person you are paying submits the invoice for payment in the bank, you may not be aware. But for this one, it is automatic. The money will be deducted and submitted to Google or Facebook. Now, the last point that I want us to look at, errors. They're about errors. And I told you errors can be made in the cash book, and I also say that it can also be made in the bank statement. But I also told you that in the previous video we talked about that when errors are committed in the cash book, then they are supposed to be adjusted in the cash book. If errors are committed at the bank, then the correction of those errors must be made in the bank reconciliation statement. And what we are going to do is that we are going to indicate the errors on both sides, because errors can be made on the debit side or on the credit side of the cash book. So we are just going to put errors made. Even here I also put errors made. I'm indicating it both sides because I said errors can be made in any way. Now, we can now look at those as our basic. So, we shall take a practical question to look at how we can be able to sort that. But I want to comment on something, how we close off this account, because it's also very important. Allow me to remove some of these so that I can be able to write how we close the account. Let me also use a different color so that we can pick it, because it's very important. Let me use even red. Now, having understood or having adjusted all the items that we needed to adjust, we need to have to balance off this account, like what we always do for every other account, these ledger accounts that we do. So what we do, we always look at which side is bigger. And these balances can be on any side. It can be on credit or on the debit. we find now, we get now the difference. If this side is bigger, we can just put the figure here as our total. We make the bigger one to be the larger value. Now, if the difference is on the credit side, then that would be a balance carried down. So we can have this as a balance carried down, let's say of this, that would be a balance brought down this side. So it will be a balance brought down this side. Balance brought down this side. Now, this balance brought down here is the one that we call balance as per the adjusted cash book. Balance as per adjusted cash book is the balance as per the adjusted cash book. So that's the balance that we shall take to our bank reconciliation statement. So that same balance, we are going to use it to start our bank reconciliation statement. And that's basically the format of the adjusted cash book. Now, let us look at the format of the bank reconciliation statement as well. But a bank reconciliation statement can be prepared from many angles, either by starting with the balance as per the adjusted cash book, or we can begin with the balance as per the bank statement. Can begin from anywhere. Because we also said that when there are wrong debits and wrong credits in the question, then we can adjust them also in the bank statement or bank reconciliation statement. And if there are errors that are committed by the bank, then we can also do them in the bank reconciliation statement. So I'm going to give you a very simple format or a very basic format of bank reconciliation statement first, and then afterwards I will explain and also add on how to correct errors and wrong debits and wrong credits that we may have. But for now, I'm going to give you a very simple and very basic format for bank reconciliation statement as per the things that we have discussed, but we shall keep on adjusting it for the different aspects that we shall look at. So the format of the bank reconciliation statement. Bank reconciliation statement. Now, we always begin by the heading. We put the date, and then you also show of course, you begin by the name of the company, you put the statement you are preparing, then you also put the date as at, you give the date of the statement, and also you bring in the currency symbol. However, I'm starting with the balance as per adjusted cash book. So balance as per adjusted cash book, as per adjusted cash book. Let me just call it CB. That is the balance I'm starting with. And we also write it as balance as per the adjusted cash book. And after that, what we do is that we are going to add unpresented checks. Add unpresented checks. Unpresented checks. There could be a number of checks. So we add the unpresented checks. We could be having maybe check number 001, 002, whichever. Then when you add them, of course, these are going to be in columns. Bring the figure here. If you add these two, bring the figure that side. So after adding those two, after adding the unpresented check to the other balance as per adjusted cash book, what we are going to do is we are going to less off uncredited checks. We can also have more than one. Can have 0, maybe 00, 0010, 005, 011. Their figures are there, their figures are there. When you add the two, you less them off here. And when you less them, you'll be able to get the balance as per the adjusted cash book. This will be balance as per bank statement. That will be the balance. That's the basic format. So once you have added the unpresented checks, but as I said, there could be more than one checks. So sometimes they may give you check numbers, sometimes they may just give you figures. So once you add them up, if they have given you very many or names of customers, you list the names of the customers and sum up their values before you add them to the balance as per the adjusted cash book. So once you add it up, you can also be able to take the figure this side, and it will be this figure that we shall less off from the unpresented checks, the uncredited checks. And after adjusting for this, after adjusting for unpresented checks and the balance as per adjusted cash book, then we can take out these uncredited checks. And these are also, you can find when they are very many, so you adjust them. If they are given you name of the people, they have the names of people or the check numbers, you write the check numbers, you sum up their totals, and you get that figure that will be deducted from this to be able to give you the balance as per. So after doing all that, you will be getting the balance as per your bank statement. So you arrive at the same, that balance as per the bank statement, you'll arrive at the same amount or at the same balance as per your bank statement balance. It will be the same. So it will always give you that same amount that they have given you in the question. Most of the times, if the bank statement doesn't balance, you just know you have made some errors somewhere. So someone may be wondering, why are we adding the unpresented checks and why are we lessing off the uncredited checks? Now, we are adding the unpresented checks because the unpresented checks are checks which have been issued to they have been issued out by the business to our suppliers or creditors, and we expected them to go and present it to the bank for payment. And in our cash book, we already subtracted that amount from our balance. In other words, we have already subtracted that from our balances. And these people, they delayed or they didn't present these checks to the bank for payment. And for us, we thought that our balance had already gone down and only to realize that suppliers did not present their checks for payments, and the balance at the bank still stands as it was. So because we took out of our cash book, we took these unpresented checks out of our cash book balance, and we have now known that they didn't actually take out money from our bank account. Then we need to add it back, at least so that we can use it to get the same balance as per the banker statement. Therefore, these suppliers, they did not present it for, they never presented those unpresented checks for payment. So the balance, all the money that they didn't withdraw, is still standing in our bank accounts, and thus we are adding it to show that the money is still available, because in our cash book we have already subtracted that as if we have already cleared them. That's why we are basically starting with the balance as per the adjusted cash book, because this is the correct balance as per our banker statement. But because there are those transactions that happened in the cash book, but they never got affected in the bank statement, we need also to adjust them under what we call the bank reconciliation. Now, at the same time, we are taking off these uncredited checks simply because these uncredited checks are checks which were received from our customers, but when we took them to the bank, we expected the bank to credit our accounts, but because maybe for some reasons they have not yet created our accounts, but from our side in the cash book we have already debited. It's like we have included that figure already in our cash book balance. So what we can do is to take it out. Let me hope you are understanding this argument, because this balance as per the adjusted cash book, this is the corrected or the updated balance, meaning this amount for unpresented checks, for us we thought it was already deducted. That's why when we are constructing this balance adjusted cash book, we started with the balance as per the cash book. We adjusted it with the things that were not reflecting in the cash book, meaning these uncredited checks, they are still within this balance as per the adjusted cash book. That's the meaning. And the reason why we are taking them out is because we want to see that balance reflecting the balance that is in our bank account. So since we had already debited our cash book to show that we have received money, or our cash book balance is increasing, but we realized that the bank did not credit our bank account. So what we will do is to subtract it from the balance as per the cash book, so that we will understand that the bank balance wasn't increased or wasn't credited as we thought it would have been. Therefore, once you are able to do that, the adjustment then will be leading you to arrive at the balance as per the bank account. And that's basically how a simple bank reconciliation statement is prepared. But before we conclude, we also have to know that the bank reconciliation statement can also be prepared in an opposite way, whereby you begin with the balance as per the bank statement. And when you begin with the balance as per the bank statement, then it means that you are adding up the uncredited checks, and then you are taking out the unpresented checks. So it can be in the other way around. Let me show you how it can be. Bank reconciliation can just put maybe bank reconciliation as at. Remember, I told you to always put the date. Bank reconciliation statement as at, you put a given date they have given you in the question. Since we are using a format, allow me just ignore the date, but you always put the date. Now, we are starting with the balance as per the bank statement. And we show that figure on the right hand side. So it is, we always do it in columns. Put 3 where you add just values. Of course, you have to show the currency. So you start with the balance. You start with the balance as per bank statement. I'm just going to call it BS, bank statement. We put it this side on the right hand. So now we add back uncredited checks. You list them if there are many, 001, 003, 00 whatever. You put the figures here. After adding, you get of course that value, then you less unpresented. May I prefer the other first one, but just know even this one is there. 008, can call it 008, 001, 002, this one, and we get this very final value there. And that's what they call the balance as. Now this one will be balance as per adjusted, balance as per the adjusted cash book. So you can prepare it in this way or in the other way, depending on which way you want to use. So we started with the balance as per the adjusted cash book, which is that one. Then we add adjusted, because now when you start with the balance as per bank statement, then you must arrive at balance as per adjusted cash book, meaning still you'll need to prepare the adjusted cash book. So you start with the balance as per the bank statement. You take the bank statement balance, and then you should arrive at the adjusted cash book balance. And when you start with the adjusted cash book balance, then you should arrive at the balance as the bank statement balance, or the balance as per the bank statement. So whichever way that you may want to go by, you'll be correct. And that's basically a simple way of presenting a bank reconciliation statement. And I think it's important for you to understand these basic dynamics, because we look at, it's better you understand this, the basic way to do a bank reconciliation before we look at other aspects. Because other aspects, I told you, we have things to do, like things to do with wrong entries and correction of errors, and other aspects that may come across. Because I told you there are going to be very many factors, others will see them, the things to do with over and under estimations, they may appear. So we are going to try and look at the case where the adjusted cash book balances resulted into a bank overdraft. Because the other side, we looked at a situation where our adjusted cash book balance had a positive balance. The balance as per the adjusted cash book, what we prepared first, was a positive. But we want to look at a scenario where our balance as per the adjusted cash book is a negative, or it comes as an overdraft. In other words, the balance appears when you are preparing the adjusted cash book. We find that the balance breakdown is going to be appearing on the credit side of the adjusted cash book, which indicates that there was an overdraft. So once you get an overdraft, how do we now be able to get these formats? Because the format may change a little bit, especially when you are looking at in the scenario where we've gotten a bank overdraft. Now, I want us to assume that we are taking our first format, the first format that we looked at, where we start with the balance as per adjusted cash book, add back unpresented checks, then you less off the uncredited checks. That's our format, first format. And then we get the first format of doing the bank reconciliation statement. So we want to look at a situation where we have an overdraft. How do we go by that? So we can just duplicate this. Maybe we can duplicate this. If this is an overdraft here, just something small I need to clarify here. So we said it is going to be an overdraft. So we either say that we have an overdraft here. Instead of saying balance as per the adjusted cash book, we say overdraft as per adjusted cash book. Or we can say balance as per adjusted cash book, and then in the bracket here we put OD, the word OD, just OD, to mean an overdraft. You can also decide to ignore that OD, and then you just show the overdraft as per adjusted cash book. So whichever way you take, whichever way you go by will be okay for the examiner. However, once you get an overdraft, then the format will change, because what we know from here is that we add our unpresented checks. But because it is an overdraft, we are not going to add unpresented checks, but rather we are going to add the uncredited checks. This side will change a little bit. Here we shall just add maybe the uncredited checks. So these will be uncredited checks. Then this side we shall only less the unpresented. So if you have this as an overdraft, you can just call it overdraft as per. So that's what you can do if at all. Now, what will happen to this downside? The balance here. The balance, of course, after adding the uncredited checks, then you less off unpresented checks, you'll be able to get that balance, whatever balance that you will get. It may be an overdraft, or it may actually be, it can be a negative or a positive figure. So once you add this, even this side may actually be an OD, overdraft. It can be a negative or a positive. So once we less off the unpresented checks, then when we do that, we shall have the balance as per the balance as per the cash book balance. Balance as per the bank statement. And still this can be an overdraft, or it can be a negative, which is an overdraft, or it can be positive, which is just a balance. So it can be, the final answer can be a negative, or it can be a positive balance. So that's the small change that I wanted to show you. But I want you to take note that you can start a question with an overdraft and end with a positive balance. Or you can start a question with a positive figure and then you end with a negative balance. All depends on how well you have understood these concepts. Now, having understood how to deal with the simple formats of these bank reconciliation statements, then I want us to understand how do we adjust the wrong debits and the wrong credits to our banker. We need to adjust wrong credits and then wrong debits. How do we adjust those? How do we adjust this in our bank reconciliation statement? Now, wrong debits means that the bank has debited your account in error, and the bank to debit your account in error, it means that they have reduced your account balance unnecessarily. And when you prepare your bank reconciliation, when we are preparing the bank reconciliation statement, we know that the two main items that we use over there are the unpresented checks and then uncredited checks, as we saw. But now we need to also ask ourselves the effects of wrong debits and wrong credits on the account balances of the business. And if the effect, so these two, we are supposed to ask ourselves, what is the effect or what is the impact of these two? That's the only thing you can know. Now, you just look at the impact. What is the impact of the wrong credit on the account balances of the business? And if the effect is the same as, so if the effect is the same as that of uncredited checks, for example, if let's say the effect between these two, or the impact is like it impacts the account balances of the business in the same way as that of the uncredited checks, for example, then we will treat that same transaction in the same way. And if the effect is the same as that of unpresented checks, then we will treat them in the same way. So we just look at the relationship. What will be the impact of that transaction on the account balances of the business? But you need also to understand that we said wrong debits means that we have reduced our account unnecessarily. In other words, we have reduced it in an unnecessary way. But when you look at the uncredited checks, they also behave in the same way, because you thought your account balance is going to increase or is going to go up, but it has not. It has been reduced. Therefore, it means that wrong debits usually move in the same direction as the uncredited checks. So these ones, the wrong debits will go in the same way as uncredited checks. So once you add back uncredited checks, even the wrong debits are supposed to be added back. If you less off uncredited checks, then wrong debits are also supposed to be deducted. So whichever format you go by, but you look at the relationship. Wrong debits, we reduced our account unnecessarily. Then uncredited checks, we thought that our accounts are going up, but unless it is reduced. So they are behaving in the same way. So the behavior of the two makes it to go in the same way. Now, for wrong credits, when we look at wrong credits, it means that the bank has given money into your account. The bank has put money into your account without your knowledge. In other words, they have given you someone's money to your account, and your account balance has increased, or it has gone up unnecessarily. However, if you look at the unpresented checks, you can see that it behaves in the same way, because we thought that the suppliers had presented their checks to the bank for payment. And for us, we had already reduced our bank account. We thought our bank account had already reduced. In our mind, we had already done that. But when we looked, when we got the bank statement, we realized that our account never reduced. It actually remained, it was high than what we expected. Therefore, when they are not presented for payment, the balances at the bank will still be higher than that of the cash book. And that money is not going to be ours. It's not for us as a business. And the bank can still remove it from our account. Because when they give you someone's money, they can rectify the error and they deduct it from your account. So it is going to behave in the same way like the wrong credits. Wrong credits are going to behave in the same way like unpresented checks. Unpresented checks. So the same way we treat the unpresented checks is the same way we are going to treat these uncredited, the wrong credits. So that's what I want you to understand from this perspective. And I want you to get it that wrong credits move with unpresented checks. Wherever it moves is where the other one goes. And the wrong debits move with uncredited checks wherever it moves. And for the purposes of remembering, we can take it that wrong debits goes with the uncredited checks, and then the unpresented checks goes with the wrong credits. And basically what we will do is maybe to move over to the bank reconciliation statement. Then we indicate those we get to the format of the bank reconciliation statement format, so that we can be able to adjust in, to include in those wrong debits and then the wrong credits. So we can assume that we are taking one format of going with balance as per the adjusted cash book, then we add in those two items accordingly. So we have, this is balance as per the adjusted cash book. The amount is there. Then we add unpresented checks. The amount will be there. Then we also add wrong credits. The amount is there. Once you have added those, you can take off less uncredited checks. Then we also less off the wrong debits. And whatever we get is what we call the balance are as per the bank statement. Now you can see we have made just a slight change in the format, where we are now introducing in the wrong debits and then the wrong credits. And we have seen that the wrong credits move with unpresented checks, and also wrong debits move with uncredited checks. However, I want to emphasize that here I did not say that we just add wrong credits and subtract wrong debits, but I said the wrong credits move with unpresented checks and the other one moves with uncredited checks. So you have to be very careful with that. Finally, I want to introduce to you how to correct errors in the financial statements that we may have. But I want to see how can we be able to incorporate these errors under our bank reconciliation statement. But what you need to know is that errors can be corrected anywhere. They can be this side up in the additions, or they can be down in the side of subtraction items, because it depends on the effect or the impact of the errors that you have. And that's why I can't say that this error can be corrected in such an area, or these are going to be corrected in this side. But what I can tell you, I can give you the general aspect or the general way of how errors can be corrected in the bank reconciliation statement. Now, correction of errors under the bank reconciliation requires a lot of technical understanding of these basic principles that we spoke about earlier, because we've talked about very many factors, and it's among those factors where we are going to be committing some errors. But you have to remember that, as I told you, that the wrong credits moves with unpresented checks, because they have the same effect or they have the same impacts on the bank statements. And the wrong debits also moves with uncredited checks, because they have the same impact or they have the same effect on the bank statement. And you have to note that I didn't say that those two, I didn't say that the we add wrong credits and we subtract wrong debits. No. I said wrong credits move with presented and unpresented checks, and wrong credits move with uncredited checks. And that is very important, and you need to note, because the implication is that wherever the unpresented checks are going to be, or wherever you find the unpresented checks, these items are going to be following them. Wherever you see the uncredited checks, the wrong debits are going to be following them. Because we've seen different formats of how to handle, where we can start with the bank overdraft as per the adjusted cash book. We also looked at how we do it when we start with the balance as per adjusted cash book, as per the bank statement. So we need to understand, but the key principle is in the effect. You look at the effect. What will be the effect of that transaction to the statement that we are talking about of the business? So if you see an error in the question, you should ask yourself, what is the effect, or what is the impact of that error? The impact of the error. What is the impact? Because once you understand the impacts of the error on the bank statement, then you can be able to know where you can put it correctly. So if that error has the same effect, or it has the same impact as the unpresented checks, and the wrong credits. So we gave two issues. We look at it in this way. We get the unpresented checks, we combine them with wrong, we combine that with wrong credits. We say those two move together. So once you see an error behaving or impacting the statement in the same way as these two, then it's supposed to be added. So if the same effect or the same impact as that of the unpresented checks and the wrong credits, then you should treat that error in the same section as well as those two items. So that error that is going to be on this side will come this side, and then the error that will be on the uncredited checks, that will have an effect which is the same as the uncredited checks, as well as the wrong debits, then that error will also come this side. So we can have errors here and then errors here. Now, how do we know that this error is going to be on this side? We look at the effect. So if they behave in the same way, then they are supposed to be in the same way. So once an error is behaving like uncredited checks or wrong debits, then we should treat it in the same way together. So the whole idea of errors is to look at the nature of the error. For example, if you are told that the bank credited our account with 10 million, let's just get this scenario. The bank credited with our account with 10 million, instead of 1 million, because they were supposed to credit our account with 1 million, but instead they credited it in error, 10 million in error, but they credited it 10 million, then it will be an error. So we need to first understand the effect of this error, because instead of 1 million, they credited it with 10 million, meaning that they have overstated our bank account. They have overstated our bank account balances, whereby they have increased the balance of our account unnecessarily. Therefore, you have to ask yourself where this error can it be corrected, because you have to remember that I told you that if an error is committed in the bank, you should always correct it from the bank reconciliation statement. And it's true that this one has been committed by the bank because they have overstated our balances. Now, we look at now the unpresented check. Now, the unpresented checks and the uncredited checks, which one of the two will overstate our balances as well? And you can see that the unpresented checks, it will overstate the balances, and also the wrong credits will also overstate the account balances, because for unpresented checks, we thought they had already withdrawn money, yet they haven't. But the balance on our account will be higher than we expected to have. And in the same way, when the bank commits an error, and then that error expects to overstate the balance, then we correct that error here with the unpresented checks and the wrong credits. So this error, we're supposed to receive this, but they gave us this. So the error that we are supposed to take here is that overstated figure. So they gave us 10 million on the credit. So what you do, you just come here and you take the difference. The difference, we take it back, and the overstatement is the one that we are taking. So it will be 10 million minus 1 million, that will give you 9 million. So once you bring it this side and you add it back, you have removed it. You have left there only 1 million. But now it may happen that if for instance, if the bank commits an error and we analyze the error very well, and we realize that the error has an effect of reducing the account balance, then that error will be corrected together with this thing. So the one that is going to underestimate, so we take the error that is going to underestimate, we take them together with these three items. I hope we are getting how we are able to maneuver through some of these items, because I told you errors will call your understanding of some of the things that we spoke about. Therefore, that's how we are going to treat the errors. And finally, I'm going to maybe to make a final draft where I want to include in the errors that will overstate and those that will understate in our complete format for bank reconciliation statement. So let's look at the complete format for bank reconciliation statement as at we put the date. Of course, as I said, we are taking the other format of starting with the balance as per adjusted cash book, balance as per adjusted cash book, that figure, then we add back. Of course, we add back unpresented checks. I said if there are many, you add them up. But let me assume it is just one value. Then we are supposed to add wrong credits. Then we also add errors that overstate. Errors that overstate the bank balance. The bank balances, we add it there. So we take the final value this side, and that will give us a certain balance that where we are going to less. Then let's go and see what we are going to less. So we are less the uncredited checks. The value will be there. Now we put it this side so that we add the others. If there are many, you first list them, you add. Then you also bring in the wrong, you less off also the wrong debits. Then you also show the errors that understate the bank account balances. So we take it that side, and then we shall have the final figure. That final figure will come as our balance as per bank statement. So that's basically what the complete format of bank reconciliation statement will look like, and I'm sure that you have now understood it very well. You can now be able to look at a practical question, but now we are going to take that practical simulation in the next video so that we can be able to understand. But if you have any question, you can put it in our comment section. We'll be waiting for those comments so that we can be able to respond before we dive into the computations, because we are now done with whatever we wanted to do. We want now to start looking at numbers. We are going to start from the very basic numbers as we keep on progressing, and we shall add just some of those different key items that will come across the different questions that we are going to be attempting. So thank you for watching. Let's be able to apply the principles and execute them practically in the next video. We'll see you there. Hello viewers, welcome back to our YouTube channel, and today we are going to continue with our series of bank reconciliation. This is bank reconciliation part 3. We have so far done 2 lecture videos on bank reconciliation. So we want to look at bank reconciliation. Bank reconciliation part 3. And in this video lecture, I want to take a practical simulation. Want to look at a practical question. and then we try to solve this question by preparing what we call a bank reconciliation statement. A bank reconciliation statement. We want to construct a bank reconciliation statement. So let's go straight into the question and we read through the question so that we can be able to solve it together. Simulation. They are saying that the CEO of KC Group group of companies received received a bank statement from its bankers for the period 1st to 31st March 2015, full stop. They are continuing to say that the balance as per the statement, the balance as per the statement was these are US dollars, 792,000 US dollars, 792,000 US dollars, while the cash book showed a balance of US dollars. These are US dollars. It's 1,219,000 US dollars. Full stop. They are continuing that on thorough examination of the books, comma, the following were detected. On thorough examination of the books, the following were detected. So part A, they are saying that the bank had debited The bank had debited KC Group with an amount of 15,000 US dollars in error. The bank had debited KC Group with an amount of 15,000 US dollars in error. Part B, they were saying that checks drawn in payment to creditors to a total value of US dollars 210,000 US dollars. 210,000 US dollars. 210,000 US dollars had not been presented. For payment. Part C, they are saying that various checks lodgements to the bank, amounting to US dollars 300,000, US dollars had not been reflected on the bank statement. Full stop. Part D, they are saying that the bank had the following items on record, but they were absent from the cash book. The bank had the records, but they were absent in the cash book. So we try to outline them. We had a standing order payment. Of an amount of 60 US dollars. We had a bank charge bank charge of US dollars 25. We had the dividend received, dividend received of 17,800 US dollars. Then we had interest on overdrawn amount, interest on overdrawn amount, and the amount was 10,000 US dollars. Then we had a bank loan deduction, of 200,000 US dollars. Then part E, they say that the cash book was detected to have been overstated by US dollars 45,000. Full stop. Then they are saying you are required to semicolon Roman number 1 adjust the cash book balance. Roman number 2, they wanted us to prepare a bank reconciliation statement. So that's the question that we have. So let's look at the solution. What are we supposed to do? So this is a very simple question that we are going to solve. And when you look at the required, they wanted us to prepare part A. They wanted us to prepare an adjusted cash book, because that's where we can get the adjusted cash book balance. And part B, they wanted us to prepare the bank reconciliation statement. That's what they wanted they wanted us to prepare. And straight away, I'll start by preparing the adjusted cash book. And then when we are done with that, we shall come back. Then we take this part 2 where we are supposed to prepare the bank reconciliation statement. But now, what are we supposed to start with? We are supposed to always start with giving the name of the company, and then we give the title. Of course, when you're giving the name of the company, it's more like we are giving the title of what we are preparing. So we give the title of what we are preparing, and that's the adjusted cash book. Of course, the name of the company, they told us it is Casey Group of Companies. So the first thing you start with the name of the company in the first line. That is Casey Group of Companies. Casey Group of Companies. Then the next thing that we are supposed to do is to show what we are preparing. We are preparing an adjusted cash book. Then if you have been given the period, you put for the period ended 31st March 2015, and that's the heading. Once you're done with the heading, of course, you draw a T ledger account just to represent our adjusted cash book. Maybe I can remove this. We use a different color. That's the column. So on this ledger account is going to be the adjusted cash book. Just this line in the middle is just to represent, like the one we use for a book, to draw a line that is separating the different pages. So we always begin by looking at the balance as per the cash book that is given to us in the question. We always start with what was given to us in the question. Of course, they told us the balance as per the cash book that was given to us. The balance was 1,219,000 US dollars. That is the balance that we are supposed to start with. And that balance is supposed to be on the debit side of the adjusted cash book, because that is the balance that we had at the end of the period. As per the cash book. So that's the amount that we start with. We start with the opening balance that we have for the previous period. We adjust that with the necessary adjustments that we are going to talk about. Then when we are done, we go ahead and get the adjusted cash book balance that we shall take to the bank reconciliation. So having written the balance, of course, this is the balance brought down. Now, having written the balance as per the cash book, the balance brought down as per the cash book that was given to us in the question, then we try to pick items that we know will appear in the adjusted cash book. And also, we know that the items that will appear in the bank statement will also be identified. So we'll read through the additional information that was given to us. Then we try and identify which key items are supposed to appear in the adjusted cash book, and those that we are going to take to the bank reconciliation statements. So where we start to get the information is from the statement where we are told that on a thorough examination of the books, that's when they went into the review of the books of the company. That's where we start analyzing the different information that they gave us to see what is going to appear in the adjusted cash book and what's not going to appear in that. So let's look at the transactions that we have. Part A, they told us the bank had debited KC group of companies with an amount of 15,000 US dollars in error. Now, when you look at this part A, you can see that this is a wrong debit. This is just a wrong debit. They debited it with 15,000 US dollars in error. So it is just a wrong debit. And we know that a wrong debit will appear in the bank reconciliation. It will not appear in the adjusted cash book. So this will be in the bank reconciliation statement. The bank reconciliation statement. Because this error was committed by the bank. So the error that has been committed by the bank, we skip it because this will be in the bank reconciliation statement, but we mark it because we know it's a wrong debit that will be taken to the bank reconciliation statement, as we shall see. That's part A. Then part B, they told us checks drawn in payment to creditors totaling to 210,000 US dollars had not been presented to the bank for payment. Now this is very clear. It is actually unpresented checks. Unpresented checks. And whenever we see checks being drawn, then it means that we, the company, we have wrote the checks. We wrote the checks, but the people we gave these checks, the creditors we gave these checks, they never presented those checks to the bank for payment. So this is very clear that these checks were drawn by the business, which is the business we are dealing with, but the customers or the creditors, the people who supplied us things and we are paying them, never presented these checks to the bank for payment. So we now know that these are unpresented checks. And of course, unpresented checks will not appear in the adjusted cash book, but still this will be part of the banker reconciliation statement. So it will also be under the bank reconciliation statement. So you need to mark that part B because it's also supposed to be the bank reconciliation. So let us look at part C. When you try to look at part C, they told us various check lodgements to the bank. So we lodged banks, like there were these lodgements of the different checks to the bank, and the total amount was amounting to 300 US dollars. So the total amount was 300 US dollars. But this had not been reflected on the bank statement. Now, these check lodgements, and we as a company, we have deposited checks into the bank. So for us, we have done the check lodgements. It's like we have deposited, we have taken the checks to the bank for us, for the bank to credit our account. But at the time we picked the bank statement, this amount or this money had not yet reflected on the bank statement. So the meaning here is that we took the checks to the bank, but at the time we picked the bank statement, the money had not yet reflected on our account. So it means they had received the checks, but they are delayed to credit our account. That's the meaning. So, and these are the ones that we call the uncredited checks. Uncredited checks. The checks were taken to the bank, but at the time when we picked the bank statement, the bank had not yet credited our account. And the uncredited checks will not also appear in the adjusted cash book. So this one will also appear in the banker reconciliation statement. So don't forget that this part C, to mark it as the uncredited checks that are supposed to be in the bank reconciliation statement. So let's look at part D. Part D, they told us that the bank had the following items on record, but they were absent from the cash book. These things, we had them in our bank account, but we never had them in our cash book. The reason is maybe the bank had made some payments, but we never received communication from them, and we only came to an understanding that there are certain transactions that happened when we picked the bank statement. So these items were in the bank statements, but they were not in the cash book. Now, all these transactions will appear in the adjusted cash book, since these were not available in our cash book. So we take things that were not available in the cash book, but they were available in the bank statement. Whether they are going to be on the debit side or they are going to be on the credit side, as long as we had them in our bank statement, but they were never appearing in our cash book. So these things were recorded in the bank statement, but we never had them in our cash book. So we try and put them in the adjusted cash book so that we include them there. So we can now start with the standing order. Standing order. Standing order payment. Standing order payment. Standing order payment, and this will appear on the credit side of the adjusted cash book as 60,000 US dollars. We were also told that we had bank charges. We also had bank charges as 5,000 US dollars, which will also appear on the credit side of the adjusted cash book because these were appearing on the debit side of the bank statement. There is also dividend received. Dividend received. We've seen that we received dividend of 17,800, and as I told you that dividend received will also be on the debit side of the adjusted cash book, since it is an income that came into our bank account. So this dividend received was money that was credited to our account, but we never had it in our cash book. So what we do, since it was on the credit side of the bank statement, we transfer it to the debit side of the adjusted cash book so that we have that included in our cash book. Now, there is also things to do with interest on a bank overdraft. We picked an overdraft. We had an overdraft. We had overdrawn our account. by 10,000 US dollars. And this means that interest on overdrawn account is just like an interest. It's basically an interest of the bank overdraft. The bank gave us a bank overdraft, which was money in excess of what we had on our account. Then the bank at the same time charged us interest on that overdrawn amount. So because the bank made us to get access to an overdraft and we took it, then the bank will be charging the company account interest. And when they are charging the interest, it will be to the debit side of our bank account, because once the bank has your money, it will be crediting it, because you will be a liability to them. But the moment they are charging you interest, it means they are going to be debiting your account, because they are reducing their liability. So they debited our account with that interest. So since it was on the debit side of the bank account or the bank statement, then we are supposed to credit it to our adjusted cash book as the interest, which is the interest on the overdraft. Then the other thing, we also had a bank loan deduction. Bank loan deduction. Bank loan deduction. Now, when the bank gives you a loan, they always automatically deducts their interest, their deduction, the monthly deduction or the annual deduction. They remove it. They may not see you that they have chopped the money, but the moment you pick your bank statement, you realize that they have actually picked their monthly or yearly installment that you are supposed to be paying for that particular period of time for the loan that they gave you. So this means that the bank is deducting its installment for the money that we took as a business, and the bank account is trying to recover money from the bank is just trying to recover money from our account, and that means it will be reducing the balances. Since the bank debited the bank account of our company, then the corresponding interest should be on the credit side of the adjusted cash book. Because if the bank had not picked money, the loan installment, you would have paid it. If you had paid it out of your cash, if maybe in the bank account you never had any money, you would have paid it. So once you pay the money, you have recorded that as a payment in your cash book. But since the bank just picked the installment from the bank account without noticing you or notifying you, then you'll find that by the time you pick your bank statement, you'll find that they have picked money from the account. And that's why we are taking it back, because we never had any idea of what had happened on our account. That's why we are taking it on the credit side of the adjusted cash book to represent the bank loan deduction. Then finally, part E. On this part E, on part E, of course, they are telling us that the cash book balance was detected to have been overstated by, this is an overstatement. Overstatement by 45,000 US dollars. The account was overstated. Now, this is our final transaction, but when we say that the cash book balance was overstated, we also know that the cash book balance, because we have seen that the cash book balance was on the balance brought down. was on the debit side, the debit side of the cash book. The balance brought down into the debit side of the cash book. And now we also know from the correction of errors that when you overstate an account, then the correction should be made on the opposite side of that account. If the balance brought down, they gave us the balance as $1,219,000 US. They told us within this amount we had an overstatement of 45,000. So it means since this is on the debit side, then we shall take the correction of the overstatement on the credit side of the same account. So it means this 45 that is inclusive within this amount, it will now be removed once we put it on the opposite side of that account that had an overstatement. So therefore, this is an overstatement in the cash book of 45,000 US. So we shall record this on the opposite side, which is the credit side of the adjusted cash book, to cancel that overstatement into the balance brought down on the debit side, and we shall call it a suspense overcast. So let's now feed all this information in our adjusted cash book. Remember, we had the balance carried down, the balance brought down. Of 1,219,000. So we are now taking we are recording the other accounts. We had the standing orders, and the amount was 60,000 US. We had the bank charges. The amount was 25,000 US. We had the interest debited or interest deducted of 10,000. We had the bank loan deduction of 200,000 US. Then we had a suspense overcast of 45,000. Then on this side, we only had a dividend received, which was an income. We received a dividend of 17,800. So those are the entries that we had. Of course, this is an adjusted cash book. Adjusted cash book. Now, that's all that we had to include in our adjusted cash book according to the additional information that was given to us. Now, what we are left with is just balancing off And when we are balancing off this account, we just balance it off in the same way we've been doing all the balancing. So we get the side that has the biggest total, we add the debit side. This is the debit side, and this is the credit side. So we add all this one and this one. Then we add this, then we compare with this. We see which one has the big amount. Now we can see that the debit side has the biggest amount. So we make it the total for both sides. We draw a rule of. So the debit side has a total of 1,237,000 US dollars. It is a 1,237,000 US dollars. Now we said the smaller side will always have that balance carried down. So the balance carried down, as at the end of the period, the balance carried down, we get the total. The totals of this minus the balancing figure. So we shall see that we have the balance carried down as 897,000. So it is 897,000 US dollars as the balance carried down. So this same amount, let me first arrange this. I did not leave a space. This is 1,237,000. So we write now the balance. The balance carried down will be on the opposite. The balance brought down. This is balance brought down of the same amount, 897,000 US dollars. So this balance brought down will be now the balance that we shall take to our bank reconciliation statement. Now we've seen that we have gotten the adjusted cash book balance is on the debit side. Now the next requirement, of course, this was our part A of the question. Then part B, they wanted us to prepare a bank reconciliation statement. So we shall start with the heading, bank reconciliation statement. Statement. It is a bank reconciliation statement. Of course, you can put the date as 31st March 2015. You can also put the currency. Can also put the currency under the title. I showed you how to make the title. So you can just show maybe the currencies here, even this side. You just use 2 columns. Now we start with the balance as per the adjusted cash book. With what we are going to start with, we start with the balance as per the adjusted cash book. So we bring it balance as per adjusted cash book. And we put this amount in the last column. The amount was 897,000 US dollars. So that's the balance that we have got on the adjusted cash book. Now, after showing the balance as per the adjusted cash book, then we go and look at the question and we pick out the items that we say they are going to be in the bank reconciliation statement. And we've said those items were items from part A, part B, and then part C. Those were the items. But we know that from the format, from the format of the bank reconciliation statement, we know that we add back the unpresented checks. So we add back the unpresented checks. We add unpresented checks. Unpresented checks. And they told us the unpresented checks were totaling to 210,000 US dollars. We would have taken this figure this side if there were many and we were supposed maybe to add them up. But since it is just a one figure, we just carry it to the last column. So once you add these two items and the item of part B, of course, these were from part B of the question. So when you add this plus this, you'll see that you'll have a total of 1,107,000. That will be the total that we shall be having. So you can add them and show the total there, or you can just leave it like that. So remember, we have brought the unpresented checks right at the end of the column, because if we had maybe wrong credits, maybe if there were those errors that we had corrected in the question, then we would have brought them there, depending, because there are some errors that will be part of this unpresented, that will be part of this item that is supposed to be added to the balance by the adjusted cash book. But since we had none of them, then we can go ahead and less off. We go and less off the, of course, the things that we are supposed to less off, they are supposed to be the things that we are going to deduct, or that are supposed to be deducted. The first one that are supposed to be deducted, we have the uncredited checks. Uncredited checks. Uncredited checks. And in this question, there was uncredited checks amounting to 300,000. So let's put this 300,000 in this first column, because there are some other adjustments that we need to make. So we put that in the first column because we had the wrong debits in the question. One of the things that we are supposed to add back was supposed to be wrong credits. But here, the ones we are supposed to deduct wrong debits. So in the question, we supposed to have the wrong debits. We had it. So we had the wrong debits, and these are things that we are supposed to less from this. So we have wrong debits, and the amount was 15,000. So we add these two, then we less from this side. So we add up those two. Of course, when you add up those two, you get a total of 315,000 US dollars that is supposed to be subtracted from the total of 1,107,000. So we add these two. We take them this side, 315,000. So these figures, we are supposed to less them off. Once you add this plus this, then you less off the 315. What will be the figure? The figure we are getting is 792,000 US dollars. And this is the balance as per the bank statement. Balance as per bank statement. Balance as per the bank statement. So therefore, this 792,000 is the same as the balance that was given to us in the question, where they told us that the balance as per the bank statement was 792,000. So after solving your question, then you should get the same balance as per what they have given to you in the question. If you get it and you find that they are different, you have a different figures, then it means you have made some mistake somewhere. And maybe that's why we are not able to do a proper reconciliation, because this is supposed to be balancing with the balance they gave it to you, as long as you have done it in the right way. So we shall look at some other questions that will have things to do with errors, because there are certain things that we have not looked at. We need to look at questions that have errors, very many errors in them, whether they are in the cash book or they are in the bank reconciliation or the bank statement. When you have dishonored checks, you have presented a check and it has been dishonored. Maybe they are understatements, then and overstatements, and so many other scenarios as we shall look at them, because these are the ways that are going to help us understand this very big topic.